If we break down this week and universal tariffs are the reason, we could see something even lower than 5,500 in the short term.
There probably is still, to some degree, a level of a correction coming. There may very well be more to come.
The market's trying to find a bottom. Things will recover.
Markets are down. It's not just a rotation underneath the surface.
I've sensed this bearish sentiment on the rise, especially in the last few weeks.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Tuesday saying hello Q2, good riddance Q1. Closing out the first quarter with the biggest quarterly loss in more than 2 years. Downgrades to growth outlooks piling up on Wall Street. And a long list of price target cuts gets even longer. Policy volatility, sinking sentiment and deep-seek surprises helping to upend the US tech trade. Meanwhile, ambitious spending plans in Europe sucking capital into the continent and sending stocks there absolutely flying. Now, as the second quarter commences, one risk dominates. All corners of the global economy will need to confront so-called Liberation Day, a major tariff push just one day away.
Tomorrow, will we get clarity? Will we get details? Will we have a sense of what the tariff bazooka actually will be? It's telling that, as you just said, John, across the board, the downgrades are already happening before we even get the announcement, because the lack of certainty is likely to persist, and it's likely, as Mike Wilson said, to be the jumping off point for negotiation more than actually some sort of definitive prescription on tariffs.
And I think the Treasury Secretary last night actually opened the door to those negotiations. He said everyone, after this Rose Garden event on Liberation Day tomorrow at 3 p.m., everyone will have the opportunity to lower their tariffs, lower non-tariff barriers, stop FX manipulation, stop labor subsidies, providing cheap loans, and make the global trading system fair for American workers again. It starts as this is the start of a negotiation, not the end.
At the moment, everyone's lowering their forecast. Equity downgrades from HSBC, from Citi, price target cuts from RBC, from Barclays, from Goldman twice. Yardeni goes again. Ed Yardeni joins us later on this morning. New price target on the S&P, 6K. Lisa, here's the quote. The expected fallout from Trump 2.0's reign of tariffs undercuts our former bullishness.
And they talk about the roaring 20s and how that scenario looks less likely, and the idea of some sort of stagflationary recession looks more likely. He said a happy outcome would be that the U.S. would negotiate tariff reductions, but that won't happen if the U.S. slaps a 20% tariff on imports all across the board. This is the key question for tomorrow. How big does President Trump go, and how much does that take off the table the potential for negotiating and putting this genie back at the bottom?
And how quickly can this story shift? Treasury Secretary Scott Bessent with these comments in the last 24 hours. No tax on tips. No tax on Social Security, no tax on overtime, and we're going to make purchasing an American car tax deductible once again.
So he was asked, of course, about the extension of TCJA, and he said, we are going to make those tax cuts, that is current policy, permanent. And then he said, we're going to layer in some of these other proposals we've heard from the president, not just on the campaign trail, but new ones we've heard out of the Oval Office. The issue is, I think it's base case that we get an extension of TCJA. It's those extra sweeteners. Can they really get through Congress?
And this is the issue right now with moving so quickly to try to restructure an entire economy that has been built up over decades, possibly in implementing the biggest tariff regime since the 1930s or the 1800s. It goes to this question of, are they moving quickly with a plan, or is this ad hoc the way a lot of people in markets are worried about?
We've got some data later this morning as well. 10 a.m. Eastern time. Look out for that. JOLTS, job openings, and later on this morning too, ISM manufacturing. From there, the data really starts to pick up. Equities on the S&P just about unchanged. Coming up this hour, Jonathan Stubbs of Berenberg following the worst quarter since 2022. Tobin Marcus of Wolfe Research counting down to Liberation Day. And the former Fed Vice Chair, Richard Clarida, ahead of tariffs and payrolls. We begin this hour with stocks falling as traders await clarity on President Donald Trump's tariffs. Jonathan Stubbs of Berenberg looking at Europe's outperformance, writing Europe had its best dollar quarter versus US equities since 1985. Jonathan joins us now for more. Jonathan, welcome to the programme, sir. Any reason for that performance, that outperformance, to continue?
Yeah, very good question. I mean, it's happened. It's in the history books now. Best quarter for Europe against the US in dollar terms for 40 years. Part of this clearly is a risk premium trade. We read about this back in October in a sort of path to upside note. citing sort of Ukraine dynamics, German dynamics, and sort of Draghi progress as the key sort of impetus for this. What happens next? We have to obviously ask that, and it's harder now to make the same case that we were making back in October in terms of the quantum of upside for Europe. For that to happen, we need the show me phase to come. The show me is earnings growth coming through. We haven't seen much change to growth forecasts for the next 12 months. The US comes into play as well. The US, I would argue, is a broken trade at this point. Happy to go into more details why, but it's harder to make the same case for Europe going forward. That doesn't mean that Europe hasn't got reasonable upside going forward. It's just harder to make the same case that we were making back in October.
Let's talk about that broken trade. Nvidia, Google losing a fifth of market cap in a year so far. Tesla losing a third. The price is reset lower, Jonathan. Is it cheap enough for you?
So, trades can last for a short period of time, a long period of time. The American exceptionalism has been for 15 years. 15 years of US equity dominance, US equity market outperformance. We've shown that a lot of that has been down to exceptional sort of US total policy impulse. If you measure the change in central bank balance sheet, the change in US government debt over that 15-year period is $30 trillion. That also matches the change in US equity market cap. So there's a very close link between how US policymakers have behaved over 15 years in the US equity market. What we're seeing now, we're seeing a price break in the trade, number one, and then number two, everything behind the US, which is what the Trump administration is doing, the rewiring of America, the remapping of the world, sets the scene for a different sort of set of fundamentals to take US equities forward. That's why it's a broken trade. Doesn't mean that US shares can't make further ground from these levels as we go through the next 12 months, but we're not in the same environment that we've been in for the last 15 years. That's a key point for global investors.
Jonathan, a lot of people have been redefining what it means to have American exceptionalism as fiscal stimulus, and simply it's been riding this wave of fiscal stimulus that the United States has been engaging in, and now that that's retrenching, exceptionalism is no longer on the table. Is it that simple?
Yes and no. I mean, the U.S. government debt has gone from sub $10 trillion pre-financial crisis to $36 trillion today, and there are forecasts 10 years out, official forecasts for that to go to sort of mid-50s. The Government Accountability Office in the US has got a debt to GDP 2053 target above 200%, and says that America's on an unsustainable path, and I'd agree with that. But what's happening is that it's dragging everyone else into the same game. So everything that's happened in Europe over the last couple of months is centered on Germany. Is Germany now also playing that game of sort of global fiscal activism or competition? China's been playing it for a long time, supporting its development, especially in sort of industrial complexes like autos, etc. And so what we have now is we have part of this brave new world theme that we've been writing about for 3 years now. Fiscal activism is at the center of that. Now Europe's playing the same game. The end result is higher for longer in terms of inflation and rates, and a completely different landscape for investors to engage with in terms of regional leadership and also leadership within equity markets in different regions.
So it goes back to what John just asked, which is how long can this continue, especially if you don't have the backing of, say, the ECB? And this came from Bloomberg yesterday, where ECB officials are questioning how much they can cut further because of exactly what you're talking about, this fiscal impulse. Does that curtail this ability of risk assets in Europe to lead to everyone just kind of not benefiting from the American exceptionalism story?
Yeah, I mean, so the European equity trade so far has been risk premium. It's been a re-rating, hasn't been sort of growth. So Europe's now trading after the rally at sort of 14 times on a sort of forward PE. That's a long run average. So from here, to get further re-rating benefits, we need sort of liquidity to come to the region. That's starting to happen, but it's very modest. Otherwise, we need an earnings growth story. And the changes to our economist forecasts, post sort of German debt brakes sort of being relaxed across the whole European region amount to about 0.1, maybe 0.2% of GDP growth from 26 onwards. So it's a small growth delta in the grand scheme of things. So yes, it's helpful. Yes, it's different. But to sort of say this is a new era of European dominance is probably going too far. So I can make the case for 10% returns over the next 12 months without stretching growth assumptions, without stretching multiples. But to get into sort of 20, 30% and beyond, we have to see much more change in Europe. We have to see much more change on regulation, i.e. sort of more relaxed regulation. We have to see lower energy prices. Politicians can do it. This is the point. They can get there if they want to. Whether they want to is a different matter.
Hey, John, I'm just going to jump in. Sit tight. It's a fluid situation, of course. We'll get an announcement from the president tomorrow. But this news just dropped in from the Washington Post, and I'll share it with you. We should stress, and I've said that repeatedly, the situation is fluid, but this is their lead story at the moment. White House aides have drafted a proposal to impose tariffs of around 20% on at least most imports into the United States, according to 3 people familiar with the matter. This coming from the Washington Post just moments ago. White House aides have drafted a proposal to impose tariffs of around 20% on at least most imports into the United States.
So obviously that'll be definitely going to the dirty 15 that the Treasury Secretary has spoken about, especially the likes of Europe. We have to remember they're not just using tariffs. They're also talking about non-tariff barriers that they want to make up for. Interesting also, this story continues to say the team is also exploring using those trillions of dollars from raising the walls and the tariff barrier into the United States for a tax dividend or refund. So finding money elsewhere to then cut taxes or give money back to the American people.
Jonathan, this could change, of course. It might not be approved by the president. We'll see. But this is the reporting coming from the Washington Post just moments ago. I'll repeat it again. White House aides have drafted a proposal to impose tariffs of around 20% on at least most imports to the United States. Jonathan, if that goes through, if you hear those words from the president tomorrow in the Rose Garden, how would this market react?
Well, this is Brave New World. This is fiscal activism. This is the era of big government. So, the wires and price action is being dominated by geopolitical events. That is our framework strategically. This is also uncertainty into markets. Markets don't like uncertainty, so that makes it difficult to make some near-term progress. But ultimately, investors have got to get their heads around what this Brave New World is, what it means, and why, for example, the best sort of performing assets year to date are European banks, gold, and Hang Seng. That's a very different world to the world that we've been living in for the last 10 to 15 years. It's all about the structure of the framework. That's what we've been writing about for 3 years. So all these events are events within that framework. Fiscal activism, big government leading to inflationary pressures, higher for longer. This is not a US-led, growth-led world anymore in terms of equity markets.
Ursula von der Leyen has said, if necessary, we have a strong plan to retaliate and we will use it. Is that where you still want to hang out then in European banks?
Well, this is the world has gone from an era of 30, 40 years of globalization dominating to deglobalization and fragmentation. So every region is having to sort of drive their growth or protect their growth more themselves, and that is a function of everything that we're seeing. Arguably, Trump is driving sort of American policy and also European policy right now. I would say, and the Europeans are in many respects reacting rationally. I also note that von der Leyen was sort of quoting IMF data earlier today and talking about the internal tariffs in Europe, which are up to 100% on sort of services. So Europe's got a lot of heavy lifting to do domestically to be more competitive as well as internationally, and it's behind the sort of the game. It's sort of 15 years behind the fiscal activism that America and China have been pushing for that period. So Europe has got to get its act together and get its act together quickly.
Hey, Jonathan, appreciate the update and the reaction, sir. Thanks for joining us. Jonathan Stubbs there of Berenberg. If you are just joining us, welcome to the programme. The latest reporting coming from the Washington Post, according to 3 people familiar with the matter. White House aides have drafted a proposal to impose tariffs of around 20% on at least most imports to the United States. Your equity market reaction looks like this. Equity futures on the S&P just rolling over slightly. We're down now by 0.2%. And in the bond market, yields are still lower, down 4 basis points to about 4.16 on 10s. We'll have coverage of this story throughout this morning. Let's get you an update on stories elsewhere with your Bloomberg brief. Here's Yahara Hackett. Say, Yahara.
Good morning, John. President Trump is playing the blame game as he pushes for a ceasefire agreement between Russia and Ukraine ahead of his 100th day in office. Trump lashed out at Russian President Vladimir Putin over the weekend, but turned his ire back to Volodymyr Zelensky yesterday, accusing Ukraine of trying to renegotiate an economic deal with the U.S. Meanwhile, Commerce Secretary Howard Lutnick could withhold promised CHIPS Act grants as he pushes companies to expand their projects in the U.S. Sources telling Bloomberg that Lutnick's goal is to generate tens of billions of dollars in additional investment without increasing the size of federal grants. And Elon Musk's SpaceX launched the first human spaceflight to fly over the Earth's north and south poles last night. The mission is carrying a crew of 4 private astronauts funded and commanded by cryptocurrency investor Chun Wang. The flight will last 3 to 5 days and will study the impact of spaceflight on human health. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later on this hour. Up next on a program, Trump's tariff gamble.
They're reciprocal. So whatever they charge us, we charge them, but we're being nicer than they were. I think they have a chance of doing better, actually, with the tariffs. It can actually help them in a certain way. And I think a lot of them will drop their tariffs.
1 day to go. Up next on a program, Tobin Marcus of Wolfe Research, live from New York City this morning. Good morning. Live from New York, good morning to you all. Equity futures just a little softer. We're down by 0.1%. No drama in the equity market. In the bond market, yields still lower. 2-year, 10-year, 30-year. Yields down across the board, down 4 basis points on 10s to 416.90. Under surveillance this morning, Trump's tariff gamble.
They're reciprocal. So whatever they charge us, we charge them, but we're being nicer than they were. The numbers will be lower than what they've been charging us. And in some cases, maybe substantially lower, but we sort of have a world obligation, perhaps. But we're going to be very nice. Relatively speaking, we're going to be very kind. I think they have a chance of doing better, actually, with the tariffs. It can actually help them in a certain way. And I think a lot of them will drop their tariffs.
So here's the latest this morning. President Trump set to announce his reciprocal tariff plan tomorrow in the Rose Garden. The Washington Post reporting, quote, White House aides have drafted a proposal to impose tariffs of around 20% on at least most imports to the United States. Bloomberg's Mike Shepard joins us now from Washington for more. Mike, that breaking news just moments ago, what do you make of that?
Well, in a way, it reflects what Donald Trump was saying on the campaign trail. You'll recall that he had floated this idea of universal tariffs on imports of all shapes and sizes and origins of up to 20% and going as high as 60% for goods coming in from China. So this really aligns with something he had been promising voters. But at the same time, many in Wall Street, many in business had simply regarded as maybe a negotiating position, maybe as something to get these trading partners to the negotiating table. But now that we are 1 day away from what Trump has been calling Liberation Day, it is starting to perhaps look like more of a day of reckoning. The president has framed these perhaps as reciprocal tariffs. But one of the challenges with doing these kind of country-specific, very bespoke tariffs is that you run the risk of creating some sort of trade and tariff arbitrage where countries will move production to lower tariff destinations. We even saw this during Trump's first administration when Chinese businesses moved some production to places like Vietnam and Malaysia and elsewhere that then exported those goods to the U.S.
Mike, coming in with a very high-end 20% tariff sounds like a maximalist approach. Could Trump still be looking to make deals with a number of trading partners?
Well, Trump is the first person to say he is looking to make a deal, and we have heard him talk about that in so many different areas, including the war in Ukraine and you name it. He really wants to try to reach an agreement. What he is looking for ultimately is, in his view, a better and fairer treatment of U.S. products and U.S. exporters on the global market. Now, how he defines those terms can conflict with how those trading partners view it. Take the European Union, for example. One of the Trump administration's biggest bugaboos with Europe has been the value-added tax. They see that as a trade disadvantage. On the other hand, in Europe, if you talk to officials there, which we all have, what we are hearing is a very different version of that. They don't see it as a trade instrument. They see it as simply taxing economic activity that happens within their borders. So to be able to get to the kind of agreement that we were just talking about, you would really have to be able to define terms and agree on them. So this is a big opening round. It is certainly going to be a wake-up call for other trading partners, and very much so for businesses and investors.
Could be a massive opening round. Shep, appreciate the update. Mike Shepard there of Bloomberg down in Washington, D.C. in our nation's capital. Just moments ago, if you are just joining us, and welcome to the program. The Washington Post reporting the White House aides have drafted a proposal to impose tariffs of around 20% on at least most imports into the United States. This according to 3 people familiar with the matter. There's an additional dimension to this story on the tax side that I think is worth highlighting, that the president's team is exploring using trillions of dollars in new import revenue for a tax dividend, Lisa, or refund.
So this would be the sweetener on the flip side of some of these tariffs that would be, as some people are saying, the worst case scenario in terms of the most maximalist in terms of tariffs. A big question here of the timeline of how hard it would be to get those through. And I will just say bonds are still rallying on the margin, but not nearly as much as you'd expect if you think about some of the projections from Mark Zandi from Parthenon talking about the likelihood of recession and unemployment rising to as much as 7% by 2027.
Tobin Marcus of Wolfe Research joins us now to extend the conversation. Tobin, good morning and welcome to the programme. How about that? 20% on all imports. Now, this can change. As we always say on this programme, I said just moments ago, situation's very, very fluid. But how does that stack up relative to what you're expecting for tomorrow?
Well, a happy Liberation Day Eve to you as well, Jonathan. Look, that's certainly at the high end of the range that we've been contemplating. Even when you throw in gross value-added taxes into the calculations of these numbers, which are the real big thing that drives them higher, 20% as an average rate or a rate that applies to many or most of the countries that are being hit here, that's definitely at the high end of the range that we've been contemplating. I think even relative to a consensus among investors that's moved towards everyone expecting higher numbers tomorrow over the course of the past week or two, that would definitely be a surprise to the high end.
Right now, the Washington Post is saying this is just one proposal on the table. Tobin, do you get a sense that the White House has actually made up their mind yet?
By all accounts, they have not. It sure seems like deliberations are ongoing. As recently as this weekend, it seemed like there were multiple reports that the idea of a flat across the board universal tariff in that 20% range had resurfaced. I do think they're going to end up with more individualized country by country numbers in this reciprocal framework. But exactly where those numbers come down does still seem to be up in the air.
Is 20% here to stay if they go with that proposal, or is this the opening of a negotiation?
So at some level, I do think that this is the opening of a negotiation. Certainly, there will be negotiations. I fully expect that there will be talks with many of our biggest trading partners. And I think there's probably room for the numbers to come down somewhat. But I think I am more concerned than a lot of the sell side about the durability of these tariffs. And I think it's really notable that in the past week, you've had both Trump and Peter Navarro talk about $600 billion a year in tariff revenue. A week before that, you had Lutnick talking about $1 trillion target for revenue from tariffs, as well as things like the new Trump gold card. Those are numbers that you can only achieve if you actually keep these tariffs in place, not briefly threaten them and then quickly negotiate them away. And I do think there's an aspiration to fundamentally redirect the global trade system. So, I think a lot of this is going to be here to stay. From a negotiation perspective, also, it's notable if VATs are the thing driving this, value-added taxes, countries are not going to be able to negotiate those away. So this talk about if they drop their tariff barriers, we'll drop ours, doesn't really work that way if tariffs themselves are not the things driving these ostensibly reciprocal rates.
Tobin, how long would it take to pass some of these other sweetener proposals that could potentially offset the growth hit from these tariffs to the United States? I'm talking about certain tax rebates or tax cuts.
I think the tax bill is probably going to be enacted in a July type of time frame. Certainly, they are trying to get it done before the debt ceiling X date because the plan in Congress at the moment is to include a debt ceiling increase in reconciliation to have that be the vehicle. So that would mean they need to get it done before probably roughly mid-August. So that late summer timeline is what we've been circling sometime in Q3. It will be certainly better news for markets than the tariffs have been. But I think from a scale perspective, what's currently on the table does not look like it comes close to fully offsetting the hit from the tariffs. Like there are good things in there, both individually and in terms of corporate tax cuts on things like bonus depreciation. But it really is at a significantly smaller scale.
Hey, Tobin, appreciate your time and reaction to the breaking news. And happy Liberation Day Eve to you as well, sir. Tobin Marcus there of Wolfe Research. Look, we've said it a few times already this morning. It's fluid. And that's a proposal. That proposal can change. We'll see what we get tomorrow and how people will respond to that. But the fact that equities aren't cratering maybe makes that proposal more likely than not.
Is that a starting place at a certain point? Because you're talking about negotiations. But to Tobin's point, how much room is there for negotiation? Can you get some sort of resolution if you have the threat of a whole host of different levies on trading partners.
Also, how difficult is a negotiation going to be when you're not just talking about tariffs vis-a-vis tariffs? They want non-tariff barriers to come down. They want to stop FX manipulation, which you can look at certain countries where the Treasury Secretary said that's a problem. They want to stop some countries providing cheap loans. There's a slew of issues they're going after here with these tariffs.
New quarter, same story. Equity futures on the S&P negative here by 0.25%. Up next on the programme, the former Fed Vice Chair, Rich Clarida, as markets brace for Liberation Day. From New York, this is Bloomberg. Snapped a three-day losing streak in yesterday's session. Equity futures this morning, though, resumed declines. We're down across the board on the S&P by 0.33%. For the month of March, the worst month in 2.5 years. The worst month going back to 2022. With 3 hours to go until that cash open, let's get to your morning movers with Yahara Hackers. Hey, Yahara.
Hi, John. We start with Newsmax up 11% here in the pre-market after climbing more than 700% yesterday in its market debut. Newsmax is a conservative media outlet, and the stock was apparently driven up yesterday by retail traders. We know the stock was one of the most traded on Fidelity's trading platform, and there was plenty of chatter about it on Reddit, where we know traders like to gather. Next up, we have shares of Tesla. Those are up nearly 2.5% here in the pre-market, despite the company posting a 37% sales drop in France. So why is the stock rising here? Well, it could be an oversold bounce. We know that Tesla fell 36% in the first quarter, or this news out of China that a Xiaomi EV with driver assistance crashed, killing 3 people. So calling into question the safety of their vehicles and potentially helping to boost Tesla in the country where we know it has struggled. And last up, we have J&J falling 3.6% here in the pre-market after a federal judge rejected its attempt to use bankruptcy to set up a fund to pay the women who say they got cancer using their baby powder. It's the third time J&J has tried to pull this in court, but a judge for the third time has said no. So the company will still need to face the tens of thousands of cases related to this. John?
Deeply uncomfortable story. Yahara, thank you. Appreciate the update. Sometimes you've got to bury your personal feelings on an issue, but something about that story, in fact, the obvious about that story is just absolutely nauseating.
That people used it for so long and got all of these cancer cases.
And you're attempting to go through the courts to avoid the claims that are being made?
So you're
I think it speaks for itself. I think everyone would be on the same page. We'll let the courts deal with this. On our radar this morning, a proposal to impose tariffs of around 20% on at least most imports to the United States. The Washington Post citing 3 people familiar with the matter. Trump is set to announce his tariffs at 3 p.m. Eastern time tomorrow.
So this looks like a maximalist approach when Trump is going after reciprocity with a number of countries. We heard from Scott Bessent yesterday, Treasury Secretary, saying this isn't just about tariffs. It's about other issues as well, like FX manipulation. My key question for the administration today, after seeing this report, would be, if this is the start of a negotiating, which it sounds like when you listen to some of the president's aides, if this is the start of negotiation, then where's the money left over to do the extras and the revenue raising that this story is also talking about? It goes on to say that they're also exploring the trillions of dollars in new import revenue. Well, the tariffs would have to stick to get those trillions of dollars to have a tax dividend or refund when it comes to tax rebates for the American people.
Just to give some perspective on what this would look like for the economy, Goldman Sachs economists now see a 1 in 3 chance of some sort of recession this year on the backs of some of these tariffs, and that assumed a tariff rate of 15%. A tariff rate of 20%, you have Mark Zandi over at Moody's, you've got EY Parthenon talking about a very high likelihood of recession this year, and potentially an unemployment rate that goes to 7% as soon as 2027. Key question is, how much does that hamper the ability of this to go through, given the fact that there are a lot of congressmen, particularly Republican congressmen, that are starting to push back and really express some concern?
The stagflationary mix and some of the forecasts as well is something we'll talk about in just a moment. Another update on another dimension of the trade effort. Commerce Secretary Howard Lutnick signaling he could withhold promised CHIP Act grants. Sources telling us here at Bloomberg the move comes as Lutnick pushes for companies in line for subsidies to expand their U.S. products.
So they want more production, especially when it comes to chips in America. They just don't want to go about it the way the Biden administration did. One issue politically is that this has strong bipartisan support, the Chips and Science Act. But yesterday, yesterday, the president signed an executive order creating this office within the Commerce Department for companies that come here and build. They're going to facilitate the speed in which you can get actually shovels into the ground and create these massive, whatever, it's a chip factory and the likes. They're using a different approach, a different carrot and stick approach when it comes to wanting to make sure they are bringing back manufacturing to the U.S.
So Howard Lutnick, according to this reporting, said that this is benefit of the deal. And I just wonder how this is going to go through the system if you have a deal and then you renegotiate the deal after making that deal without necessarily changing some of the parameters. That is a real question. How do they do that? And then how do they sort of go forward with other deals and have the validity, understanding that they'll stick?
We might find out. In the next few months, at least, anyway. Wanted to finish on this story. Microsoft-backed AI firm Builder AI lowering its sales figures and hiring auditors to examine its last 2 years of accounts. In a major setback for the company, the CEO saying, quote, "We need to do a little bit of work, making sure we get our house in order." The hits keep coming for this part of the tech universe.
That's the right way of framing this. How much are the golden geese we've been looking at really just tin painted with some sort of gold patina? And this is sort of the question as we talk about the potential for some sort of AI bubble. As you start to see malfeasance or some sort of auditing issues, hallmarks of a moment where you just saw the NASDAQ lose 8.3% in a quarter.
It's not been a good week. It's not been a good 3 months for those particular stocks. Let's get to it then. Investors looking ahead to a big week of data leading up to the payrolls report. Former Fed Vice Chair Richard Clarida writing, consensus look too sanguine on the economic data. We see downside risk to 140 consensus for non-farm payrolls, and we see upside risk to the unemployment rate relative to consensus. I'm pleased to say that Richard joins us around the table. Rich, good to see you.
As always.
Good morning. I think we've got to start with that Washington Post proposal. What on earth does the Federal Reserve do if they come out tomorrow and unveil 20% tariffs on most imports?
Well, as I think you mentioned, it is a maximalist approach. And at least right now, if this reporting is correct, it doesn't look like it's so much country by country. Maybe this is the floor. But yeah, no, this is a much bigger hit to tariffs, I think, than most people were thinking, presumably the Fed even a couple of months ago. What does it mean for the Fed? You know, I think Jay Powell at the March meeting, at least to me, signaled they're happy to basically sit on the sidelines. I don't see them acting preemptively to cut rates because they may be worried about a downturn. And so what that means is that it will take tangible data of a slowdown in payrolls, maybe a big pop in unemployment. So I see the Fed on the sidelines until the macro data really turns.
How long can they wait on the sidelines if there's damage being done just off the fact that there's so much uncertainty and potentially, if this is an opening gamut, that uncertainty can persist for the next few months?
Annmarie, I think it's an excellent point because we saw a preview of this in 2019. We had a lot of trade policy uncertainty, not very many actual tariffs that got put in place. Uncertainty is a headwind to growth. I think it's already slowing the economy. I don't think the uncertainty is going to be resolved tomorrow, especially if there's a negotiation as part of this. And so it's a headwind to growth. And I think the balance at the Fed right now is because of the stagflation threat, that inflation will be going up at least for a while and the economy is slowing. I think it makes the decision one that's a tough one, but I do think that on balance, they're on the sidelines until the data really does turn.
So there's a question of what they plan to communicate, how they plan to use their tool of talk. And that seems like a new trend, or Jay Powell speaks. After every non-farm payrolls report, he's going to be speaking yet again on Friday voluntarily. What is the message that he's looking to convey?
My sense is he will not wander too far away from the press conference a couple of weeks ago, where he really did not really embrace the SEP projections of 2 cuts. He basically said we had to write something down. And so I don't really expect him to move beyond that. They're really in a wait and see, a wait and see mode when it comes to the data. But importantly, I don't see them acting preemptively as the Powell Fed did when I was there in 2019. We cut rates because the economy was slowing on the uncertainty, but inflation was 1.5%. It wasn't close to 3%. So it's a different set of conditions now.
Could you just give us a sense of how much you've increased your chance of true stagflationary-like environments if you do get some sort of maximalist tariff proposal like what we're hearing from the Washington Post this morning?
Well, I think we already have at least a whiff of stagflation right now. Inflation mechanically will be moving up with the tariffs. Also, we're seeing some evidence, Lisa, that even goods prices before the tariffs go into play, goods prices are going up. So I think slower growth, higher prices. We have a whiff of stagflation. The real question for the Fed is this 6 months, or is this really becoming the new story for the next couple of years? And I think, again, it's too soon to tell, because this could come down to the art of the deal eventually.
Were you surprised to hear the T word make a comeback in the news conference? Transitory.
Well, I think a reporter did put that in the phrase. Look, as you know, I've said on your air, I was a charter member of Team Transitory, so I know the history on that. The textbook says the Fed should look through it, but I think they've correctly been reminding folks that only goes through if you're convinced, as Jay Powell, that inflation expectations are well anchored. And unfortunately, the UMISH data is going in the wrong direction right now.
We're conditioned by experience. Do you think they'll be conditioned by the experience of 21,
oh, yeah,
22?
Absolutely. Well, the combination of the experience and the fact is, even before the tariff discussion, core inflation was running at about 2.8%. It wasn't 2 or 1.5. So it's that experience plus the initial conditions coming into the year.
How much do you get the sense that there's real division right now in the Federal Reserve? That there's a sense from some people that they need to prioritize inflation and the fight there, and they think it's overly cute to really talk about transitory or talk about the likelihood that this tariff wave is like what we saw back in 2018?
I think there probably is a range of views. In particular, the president of the St. Louis Fed has staked out in a recent comment that it would be risky for the Fed to put too much on transitory, and other folks, including Governor Waller, have reminded them of that analysis. I don't see a big split right now, and interestingly enough, I don't even see a split on the wisdom of perhaps acting preemptively to cut rates as we did in 2019. I think they're pretty aligned on the view that they're just going to sit tight, and with the potential cost that the data would have to turn south to get them to act.
Given that, is the Fed put as we've known it not in existence anymore?
There is a Fed put, but it will be a put that only is deployed after the data has turned. There's not a 2019 example where the Powell Fed cut rates 75 basis points because of concerns that trade policy uncertainty might push the economy lower.
Is that a commitment to being late?
It's a commitment to not being early. I'll put it that way.
Is that the greater risk then?
I think it is. Yeah, and I think we've discussed that before. Yes, of course.
Thoughtful stuff, Rich. As
Thank
always,
you.
The former Fed Vice Chair, Rich Clarida, on some of the risks facing this Federal Reserve, going into what could be a big day tomorrow, the prospect of some big tariffs.
This ain't your mother's Fed put. That's all I can say. If they're promising to be late, they're not going to come in and jawbone a market or be able to do that. It just shows how different we are right now and how different the setup is than in 2018, both economically and just with a set of tools from policymakers that potentially could change the scene.
2018, and Rich said it. You were dealing with 1.5, 1.8 inflation level. It was much easier for the Fed to act and really consider tariffs as transitory, a one-time hit. That's very different this time around.
Different starting point, that's for sure. Equities this morning kicking off Q2, negative by a third of 1% on the S&P, with an update on stories elsewhere. Let's get your Bloomberg brief with Yahara Hacker. Say, Yahara.
Hi, John. White House aides have drafted a proposal that would impose roughly 20% tariffs on most imports into the U.S. The Washington Post reporting, citing 3 people familiar with the matter. The report comes ahead of President Trump's Rose Garden news conference on tariffs set for 3 p.m. Eastern tomorrow. Meanwhile, Marine Le Pen has criticized the court ruling barring her from running for elected office for 5 years. In an interview on French TV, Le Pen, who was convicted of embezzlement, claimed the decision was politically motivated. In addition to the electoral ban, she was sentenced to 2 years in prison. And SoftBank Group is said to be seeking a loan of as much as $16.5 billion to help fund AI investments in the U.S. Sources telling Bloomberg talks with banks are in the early stages for a bridge loan with a time frame of about 12 months. We're told the money may help SoftBank lead a $40 billion funding round for OpenAI. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara a little bit later. Up next on the program, eroding dollar dominance.
The tariffs are stagflationary. It's really what's knocked the dollar off its perch. If you recall, we started this year off with the U.S. running at full speed. Everyone bullish on U.S. equities, the U.S. dollar, and really we kind of hit a wall.
The dollar definitely hit a wall. Up next on the program, George Saravelos of Deutsche Bank from New York. You're watching Bloomberg TV. Live from New York City, hello Q2. Equity futures right now negative 1/3% on the S&P. We're down by 1/4% on the Nasdaq 100. Earlier this hour, the Washington Post indicating the White House has drafted a proposal to impose tariffs of around 20% on at least most imports to the United States.
The maximalist approach that a lot of people have projected would do potentially the most disruption to the U.S. economy. The question that we've been talking about all morning, is this the beginning or is this the end point in terms of where these negotiations are going?
Under surveillance this morning, eroding dollar dominance.
The tariffs are stagflationary. They have an inflationary effect, but they also have a deflationary effect. It's really what's knocked the dollar off its perch. If you recall, we started this year off with the U.S. running at full speed. Everyone bullish on U.S. equities, the U.S. dollar, and really we kind of hit a wall. And it's really just due to this policy uncertainty.
So here's the latest this morning. The US dollar posting the worst month going back to November 2022 as policy uncertainty weighs on the currency. To discuss, George Saravelos of Deutsche Bank joins us now for more. George, welcome to the program. I think the big question we were trying to answer in the first quarter, and you might not get an answer for a while, are we at risk of losing safe haven status for the US dollar in this FX market? How are you and the team thinking about that question at the moment?
Hi, John. So it's obviously a very big question, and there are many moving parts to what we consider the safe haven aspect of the dollar. I would say at the core of dollar allocations at the end of the day has just been US outperformance. The US has been growing more than the rest of the world. And in all these global shocks we've seen, if you think about COVID, if you think about the Russia-Ukraine crisis, the US has outperformed. It's been less exposed. So if you own US assets unhedged, the dollar's tended to rally with these shocks. So it served as the perfect safe haven, so to speak. But now you're seeing a shock that's internally generated inside the US. It's leading to US underperformance, and you're seeing US assets underperform and the dollar weakening at the same time. So I think that is the first component of potentially an unwind to this dollar exceptionalism status that has been around for the last decade or so.
So, George, that's one element, as you say, of the story, risk assets underperforming. There's a more important one, I think. When things get bad, are we still buying US Treasuries? Any reason to believe that's going to change?
So that goes into the second, more structural, more difficult question. If you go back to why does the market buy Treasuries, it's a deep market, it's a liquid market, it's a safe market. The US is the Western world's security guarantor. It has secure property rights. And I think the challenge over the last few weeks that we see many investors perceiving and the question asking is, when there is a discussion around Greenland, when there are discussions around the broader security architecture, can that position be taken for granted of US Treasuries? I think it's obviously a very big question, but we are undergoing transformations to international relations and geopolitics that we haven't seen for many, many decades. And I think it's a valid question to ask. It is definitely being asked in client meetings and conversations we're attending.
George, we've been talking about this for quite a while. When does the dollar lose its haven status? And people say, well, it might lose its sheen a little bit in the near term, but it won't necessarily lose its status overnight. There might be sort of a slow bleed over the next decade or two. Is that kind of how you see things?
I think if you look at the history of so-called reserve status and the pound sterling used to hold that role, now it's the US, it is many different things coming together all at the same time. And by extension, they're not going to evaporate overnight. I would have sympathy with that. But I would say over time, if various things add up, you do see the ingredients for potentially a lower allocation into dollar assets. I would say the starting point is always going to be the cyclical position of the US. The reason the dollar has done so well is it's had a much more superior cyclical economic outlook compared to everyone else. Now, if that's deteriorating, you naturally see the dollar weakening for cyclical reasons. But I think in the background, all these other changes in the conversation that are taking place on the geopolitical front, in terms of security guarantees, these things do also matter for a currency as for a currency's reserve status. We've definitely seen it through history, and there's also plenty of academic papers that have been written on the topic.
So a number of people have said to me, gold is telling us something. Listen to gold. Gold just posted its best quarterly performance since 1986. Other people say, yeah, maybe, but it also is a perfect hedge for a whole host of different trends that a lot of people are piling into. From your perspective, how much are you listening to signals from gold, and what are they?
So remember, the gold has been going up for the last 5 to 10 years, even as the dollar's been going up at the same time. So to your point, there's been other things that have been supporting gold. But I do think there is an element of that, of diversification away from the dollar. What we look at is not just one thing, gold being one of those, but the broader picture. So we're looking at the dollar equity correlation, which is starting to change. I think monitoring term premium in US Treasuries, which is the genuine measure of risk, and how that's shifting versus other bond markets. Are we seeing an elevation of term premium? That's also important. The bond equity correlation itself. Could we be in an environment where bonds are refusing to rally even as the market is pricing much slower growth? I think it's all these components that will start giving us a market signal around some of the more medium-term shifts in relative portfolio allocation.
As we look ahead to tomorrow and the tariffs that are going to be announced by the president, do you think all the headlines are baked into the dollar? How do you expect the dollar to react tomorrow if we get, say, a 20% tariff rate on most countries?
That's a great question. It's one that's preoccupied the market through the entirety of the year. I would say this 20% headline we've got from the Washington Post, we got hints of that from Peter Navarro over the weekend, where he talked about 600 billion revenue on an annual basis. If you apply that to a 3 trillion import tariff, it's 3 trillion import base, it's roughly a 20% effective tariff rate. So I would say by tomorrow, that 20% number should be generally baked in. The key question, of course, is why isn't the dollar rallying a lot more than what people were expecting at the start of the year? And I think one point goes to just this broader downgrade of US expectations. But there's a second one, which I think bears a lot of, is worth emphasizing, which is fiscal activism outside of the US. And what we're seeing in Europe, we saw it by the German announcements. For example, if you think about the Canadian election, which is soon to be concluded, I think it's very likely that you will see a lot of fiscal activism outside of the US to offset these tariffs. By extension, the impact becomes less asymmetric if the rest of the world is able to support the global economy. While in the US, there's still a very large debate on where the fiscal stance is going with these tax negotiations still taking place.
We're trying to figure that out too. George, appreciate the input this morning. Thank you, sir. George Saravelos there of Deutsche Bank. Trying to figure this out. The Treasury Secretary Scott Bessent speaking in the last 24 hours or so. No taxes on tips, no tax on Social Security. The list goes on and on. No tax on overtime. We're going to make purchasing an American car tax deductible again. So their list of demands for Congress still building.
It feels like the Oprah Winfrey election is now becoming the Oprah Winfrey administration because they keep adding to the list of what potentially could be these sweeteners and these tax cuts. The issue is they have to get everyone on board in a very slim majority to even sign up for the extension so far of TCJA, let alone potentially maybe one of these add-ons when it comes to tax cuts. No one thinks they're going to get this entire list.
This is a broader restructuring of how the United States does business, and they're trying to draw back manufacturing to the U.S. and make things cheaper on the flip side, to use these tariffs truly as a tax. The issue is sequencing, and the issue is timing. Can they do this so quickly without massive disruptions to a massive economy?
We've said repeatedly on this programme over the last several weeks, this is the strategic anchor of the equity market bulls. They still believe the overall policy mix, the more complete platform, is still pro-risk and pro-growth. And a big dimension of that is the tax plan. Some details of that coming from Secretary Bessent in the last 24 hours or so. Up next on the programme, Ed Yardeni of Yardeni Research, alongside Bloomberg's Laura Davidson, Francisco Blanch of Bank of America on a big call for gold. And we'll catch up with John Bilton of JP Morgan Asset Management from New York City. The second hour of Bloomberg Surveillance, up next.
April 2nd at midnight, lots of tariffs start going on. So it's going to be a really long day.
We don't expect that large tariffs on Canada and Mexico will stay. I don't know that I'd look for just broad-based universal tariffs. I think it's a negotiation point.
I think anytime Trump is threatening tariffs on a product, there really isn't much negotiation to be had.
What we know about tariffs is tariffs increase costs. How much they increase consumer prices remains to be seen.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The second hour of Bloomberg Surveillance starts right now. Welcome to the program, everybody, with your equity market negative a third of 1% on the S&P 500. On the Nasdaq 100, a little bit softer as well. We're down by about a quarter of 1%, down a tenth on the Russell. Equities a little bit softer to kick off Q2. Lots of economic data through the week. It starts later on this morning with the ISM and JOLTS, ISM manufacturing, before we get, of course, ADP, jobless claims and payrolls later on in the week. Before we get there, of course, the big one. The big one's 24 hours away. A ton of tariffs set to come from the President of the United States, and the latest indication from the Washington Post is it could be very big. This is their reporting. White House aides have drafted a proposal to impose tariffs of around 20% on at least most imports to the United States.
And that would be the maximalist approach that a lot of people have been mapping out, and above where Goldman Sachs was looking for still a 1 in 3 chance of a recession this year. Key question is it a negotiating jumping off point? Is that something that you can do if you invoke the ire of some of your trading partners at the same time? Key issue for a lot of people is the downgrades are happening before we even get some of these tariffs or the details, because no one is expecting the uncertainty to go away.
Is it a start of negotiation, or is it the start of new revenue raisers that, and this report talks about the fact that maybe then you can have a tax dividend or refund? It depends who you ask in the administration. I look at this story and I say, this sounds like a proposal that potentially came off the likes of Peter Navarro's desk. And then I hear from the Treasury Secretary last night saying everyone will have the opportunity after the president's announcement, meeting other trading partners, to lower their tariffs, saying it's a negotiation. The situation, I think, is still fluid to this day, depending on what the president is going to do tomorrow in the Rose Garden.
Some of these ideas are very incompatible, highly contradictory, if you will. Just think about it. At the same time they're saying that they're going to raise all this money from tariffs, they're also saying all the money will be spent domestically instead. Can you do both? At the same time they say it's going to be a revenue raiser, they also say you can negotiate things. Can you do both?
No, because essentially if you want to raise revenues, they've got to stick. If you want to negotiate, you've got to take them off. The revenues don't come in. People are trying to count it up and saying, actually, my head is spinning. I'm not going to even try. Let's wait to see what they propose. Either way, that is the reason why people are downgrading their expectations, because the uncertainty is not going away. And it's unlikely that this is going to come into crystal clear focus tomorrow in the Rose Garden at 3 p.m.
I imagine how the president might see it is starting a maximalist approach, very on brand for President Trump, who wants to be a deal maker, see who you can make deals with. And then the ones that you can't, then those will be the revenue raisers. But then it's very difficult to put figures like $6 trillion on this kind of tariff plan if you're willing to make those deals along the way.
We're desperate for clarity. Are we going to get it? Lisa, that's essentially what you're asking. This is the reaction we've had from Wall Street so far. Max Kettner, tariff noise likely to extend beyond the 2nd of April. Julian Emanuel of Evercore. A peak, not an end to the uncertainty. And you talked about what we heard from Mike Wilson of Morgan Stanley. Not a clearing event for him and the team.
Yeah, the reciprocal tariff announcement should offer some incremental clarity, but it's likely a stepping stone for further tariff negotiations. That was Mike Wilson. The fact that David Costa of Goldman Sachs downgraded his expectation for the S&P 500 year-end target twice in 1 month with possible downside ahead gives you a sense of how quickly this is moving, and it is moving in one direction, even without some of those clarifying moments that we're expecting to get.
In a moment, we'll talk to another man who did just the same. Ed Yardeni of Yardeni Research on another equity downgrade. Francisco Blanch of Bank of America on gold's record-breaking rally. He'll join us later. And then we'll catch up with John Bilton of JP Morgan Asset Management on the countdown to Liberation Day. We begin this hour with stocks sliding after their worst quarter in nearly 3 years. Ed Yardeni of Yardeni Research cutting his S&P 500 price target to 6K from 6,400, writing the expected fallout from Trump 2.0's reign of tariffs undercuts our former bullishness and dims the prospects of our base case roaring 2020s scenario. Ed joins us now for more. Ed, good morning. Good to see you. Second change for you in a number of weeks.
I hope you're not looking for clarity from me, because I'm struggling with all the confusing information coming out of Washington. As you said, you're getting different messages from different people in the administration. And at the end of the day, it'll all depend on what the president concludes he wants to do that day, and he could change his mind again.
How much damage do you think the accumulating uncertainty is doing already to the underlying economy?
Well, if you look at all the soft data, which is very much forward-looking, it's not looking good. The current data, the present data, looks pretty good. The labor market is doing fine. I think we had some really cold weather in January and February that depressed consumer spending. So I think we're going to have this really bizarre scenario where the first quarter we got real GDP up 1%. I know others have it even lower than that. Then it could be something like 3% in the second quarter, because you could really have a nice rebound in consumer spending, and consumers could be running to buy cars before the prices go up, which will be kind of another possibility. And then in the second half of the year, we could have stagflation, where the economy in a growth recession, maybe very little growth, if any, maybe even a shallow recession. And so that's the way I'm kind of seeing this thing playing out in terms of its impact on the economy.
And right now, you and the market are focusing on the reign of tariffs. What happens when we're focusing every day on this potential extension of TCJA and other tax cuts that we may get? And they're focused on having this done before September.
Yeah, well, it's going to be, if you think it's messy now, it's going to get even messier if you, on top of the whole tariff issue, which isn't going to go away just because they announce what they mean by reciprocal tariffs. I mean, the 20% number that's out there basically suggests that now the president is looking to raise revenues. Navarro's saying $6 trillion is what he claims that this could raise. And now, on top of that, we start to try to extend the tax cuts. And an extension of tax cuts, it's not stimulative. It'll be very negative if they don't get the tax cuts extended.
Well, the Treasury Secretary last night is talking about that they want to get done no tax on tips, no tax on Social Security, no tax on overtime, and also purchasing an American car, making that tax deductible again. Mm-hmm. If you have even one of those sweeteners, would that be bullish for the market?
Well, I don't know that that'll make it that much easier to get it through Congress. I mean, it is a volatile situation in Congress. The margin that the Republicans have is very narrow, and the Republicans don't always stay united. So, no, I don't know that those particular issues are going to be market moving at all.
At a certain point, if people are talking about the likelihood of recession, what gives you the idea that this is going to be more stagflationary than just traditionally recessionary?
Well, the thing that we all have to worry about, of course, is the consumer, and the consumer confidence numbers have all been depressed. The animal spirits that we all were kind of counting on to keep the stock market going and consumers going is kind of fizzled away here. And a lot of it has to do, obviously, with the kind of disappointment. Consumers were expecting that the administration would focus on somehow lowering prices. And instead, now we will have higher auto prices if we're going to have a 20% permanent tariff on autos. And of course, if we have a 20% tariff across the board, prices are going to go up. So that's disconcerting.
I guess that the reason why I ask this is because, to Neil Dutta's point, a one-time price adjustment, but if you have less demand, you'd imagine that would be a one-time price adjustment, and then you won't be able to have the ability to really raise that, especially at a time where potentially the labor market could come under some stress. So what is giving people the sense that this time is different, that there could be a prolonged inflationary type of bent that raises questions about U.S. Treasuries, that raises questions about what the Fed can do?
Sure. I mean, it's not likely to be a one-month event where, you raise the tariff and the CPI goes up to one level and it's a bad month for the CPI and then it comes back down. As a matter of fact, we raised our inflation outlook for the rest of the year from 2 to 3% to 3 to 4%. I think it's going to show up that quickly. And I think it's not going to be that transitory. It's not going to be 1 or 2 months. It's going to last for several months. And again, this is an ongoing dynamic process. We don't know whether more tariffs will be added or reduced. It's just kind of confusing, but I think companies have already anticipated that their costs are going to go up. Certainly, if you're in manufacturing, your costs are going to go up from all the parts. And as a result of that, we're seeing price kind of forward indicators of inflation showing that there's a problem. And so that the regional business surveys, for example, are also showing that prices paid are going up.
Begs the question, Ed, why do you think stocks are going higher by year end?
Well, I'm kind of counting on the market to look forward as it typically does, and I'm kind of hoping that all these issues get somewhat resolved by the end of the year, and I think the market starts to look ahead into 2026. I haven't given up on my roaring 2020 scenario.
Sticking with it.
I'm sticking with it. I think it's got temporarily waylaid by all this tariff issues and all these policy balls that are up in the air. But I think I guess my underlying thesis is look how well the economy has done in the past, despite Washington. And so I'm hoping that'll work again.
We've continued to underestimate the performance of this economy over the last several years. That's certainly been a feature.
Which is the reason why a lot of people are saying that actually you could see gains and you could actually see ongoing inflation. Because if you are underestimating the power of the consumer, they will be able to absorb some of this and they will keep spending. And companies know this and know that they don't have a sense of that price target as much as pre-pandemic.
Equities right now on the S&P negative by 0.4%, just a little bit softer. Ed Yardeni of Yardeni Research will be sticking with us. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. European Commission President Ursula von der Leyen says the bloc is ready to retaliate to protect itself against President Trump's tariffs if needed. The EU is considering a range of options, including using its anti-coercion instrument to restrict trade and services, intellectual property rights, and access to public procurement. Meanwhile, Huawei posted its first quarterly net loss in years after U.S. sanctions forced it to spend aggressively on R&D. The Chinese tech giant says its net loss in the December quarter stood at around $41 million. Huawei, however, did report gains in its smartphone business, cloud computing arm, and its core telecom unit. And the Trump administration is threatening to scrutinize billions of dollars in federal funding for Harvard University as part of efforts to combat anti-Semitism on college campuses. The review includes nearly $9 billion in grants and more than $250 million in contracts. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later on this hour. Up next on the programme, President Trump's big tariff push.
They're reciprocal. So whatever they charge us, we charge them, but we're being nicer than they were. I think they have a chance of doing better, actually, with the tariffs. It can actually help them in a certain way. And I think a lot of them will drop their tariffs.
We'll get the latest down in Washington in just a moment with Bloomberg's Laura Davidson and more from Ed Yardeni of Yardeni Research from New York City. This is Bloomberg. Equity futures softer across the board as we begin Q2. We're down by 0.4% on the S&P, a little bit lower as well on the Nasdaq, down by 0.4% also after snapping a 3-day slide in yesterday's session to close out Q1. Q1 closed with an ugly month of March. March, the worst month in more than 2 years. On a Russell, was softer by 0.2%. Under surveillance this morning, President Trump's big tariff push.
They're reciprocal. So whatever they charge us, we charge them, but we're being nicer than they were. The numbers will be lower than what they've been charging us, and in some cases maybe substantially lower, but we sort of have a world obligation perhaps. But we're going to be very nice. Relatively speaking, we're going to be very kind. I think they have a chance of doing better, actually, with the tariffs. It can actually help them in a certain way. And I think a lot of them will drop their tariffs.
So here's the latest this morning. White House aides drafting a proposal to impose 20% tariffs on most U.S. imports. The Washington Post citing 3 people familiar with the matter. President Donald Trump is set to unveil details of his tariff agenda from the White House Rose Garden tomorrow afternoon. Joining us now for more is Bloomberg's Laura Davidson. So, Laura, welcome back to the programme. Help us put it all together. What's the latest this morning?
So the latest is that Trump is essentially reverting to what his campaign trail proposal was, which is a 20% tariff on all goods coming into the country. This would be on top of the other tariffs on steel and aluminum and autos that he's already unveiled. So for some countries, for example, South Korea with a lot of car imports, that would be 20% plus 25% for a whopping 45% tariff. This is all not finalized yet. This is coming out tomorrow at 3 o'clock. The president is planning a Rose Garden ceremony to unveil all of these. But even even in these final hours, his aides are still detailing this plan, and we still are hearing from CEOs who are going to the White House to lobby for some sort of exemptions, leniency, or even perhaps a delay.
Laura, it doesn't sound like a decision has been made, does it?
No, and this is really, how Trump frequently makes decisions. He has a bunch of people coming to him, a bunch of ideas. In the final hours, he will make a call here. Of course, this is a very complicated plan, potentially how he originally conceived it as a reciprocal tariff plan with a different tariff rate for every country. What we're seeing here is his aides sort of in the final days saying, look, we don't have time, we don't have agreement, we need to move forward with a plan, and this is the simplest route.
And Laura, from here, can we get on to taxes? We heard from Secretary Besant, the Treasury Secretary Scott Bessent, in the last 24 hours, who said no tax on tips, no tax on Social Security, no tax on overtime, and the list goes on and on. How quickly can we move towards getting that passed?
So the Senate is moving today to make some steps. They are going to unveil their budget resolution. They hope to pass that later this week. That really unlocks the process where the House and Senate can start negotiating the details over this tax plan. We've heard from Senate Majority Leader John Thune, House Speaker Mike Johnson. They want to get this done by the end of April or the end of May. That's a really ambitious goal. But they really, the real deadline they're facing right now is sometime in August because this bill will also include a debt ceiling increase. And that's when forecasters say we are likely to need an increase in the U.S. borrowing limit.
Hey, Laura, appreciate the update. Laura Davison down in the nation's capital in Washington, D.C. That has the potential to change this conversation, but it could take months and not weeks.
It could take months and weeks. And also what I think is interesting, we talked about this last week, the fact that they're now putting in the X date, the idea that you have to have reconciliation done in time to make sure you can lift the debt ceiling means that they're putting a deadline to get these tax extension done in time before September, when potentially we might get this X date. They think is middle of the summer. So that's the administration really trying to drive this home when it comes to the competing forces in Congress.
Still with us around the table here in New York, Ed Yardeni of Yardeni Research. Ed, let's continue the conversation. Have you ever seen sentiment this bad this week outside of a recession in the United States? You've been doing this a long time, have you?
Yeah. Well, that's my concern is we could see sentiment push us into a recession. And of course, the stock market could do the same. I've got a lot of friends who've retired or are retiring, and they were looking forward to having a pretty good retirement because their assets were all going up. And now all of a sudden they see that their assets are going down on the stock side, and that's got them nervous. And I think the baby boomers have been actually keeping the economy growing in the face of a very significant tightening of monetary policy. The consumer kept going.
If you ignore the headlines, though, and you look at the Trump agenda more holistically, tax cuts, deregulation, and tariffs.
Looks well. The first two look good. Well, it's a mishmash. Everybody recognized all along that it was a combination of policies that could be restrictive and slow the economy down, and policies that could be stimulative. In Trump 1.0, they started out with the tax cuts, and then they went to tariffs. Here they started with tariffs, which has got everybody confused, and sentiment is down, and the stock market is down. And right now we're seeing the restrictive aspect of their policy. Deregulation is something that's probably ongoing. I think there's things going on in the energy field, for example, that certainly can be characterized as deregulation, but they don't make the kind of headlines that affect consumer sentiment, business sentiment, and so on. So I think it's kind of more of a long-term effect, whereas the short-term effects are weighing on the economy.
Where does this leave the bond vigilantes, who you thought were being resurrected not so long ago, and all of a sudden are kind of mired between recessionary fears and a budget that may or may not be expanded?
Well, I think they're confused like everybody else. I think the one area where there are a few areas where the Trump policies have been very, very successful. Shutting the border down has been obviously a big success so far. But the other thing is the tariffs have actually forced the Chinese to stimulate their economy, forced the Germans to stimulate their economies, and their bond yields have gone up, and the bond market is a global bond market, so it's helping to actually keep our bond yield from falling. I think if it wasn't for that, the bond yield might have actually come down some more. But meanwhile, the bond market is sort of on hold here, waiting to see what the Doge committee delivers. Every single day there's some announcement of big cuts in the spending that they're able to come up with. But the reality is we don't know what the final number will be.
Ed, are you convinced by the potential for Doge to do something big?
Well, day by day, it sounds like they're uncovering all sorts of amazing excesses, but I'd like to see what the final number is of what it actually adds up to. And relative to the size of the deficit, relative to the size of outlays, it could unfortunately turn out to be a drop in the bucket. I mean, it would be wonderful. I mean, look, if they come up with $100 billion in cuts and you multiply that by 10, because that's the way we usually look at the deficit, $1 trillion is real money.
Michael Hunter of Bank of America wrote recently in the past few weeks that this market has been driven by Doge and DeepSeek and not tariffs. Can we talk about that a little bit more? When you go through some of these big names in Q1, talking about mega cap tech, when you talk about retirement, we're depending on these names performing and driving this S&P 500 higher. Yeah. Nvidia, Google losing a fifth of their value in the first quarter. Tesla, a third. What's happening to big tech in America?
Well, what's interesting is, big tech is to a large extent a Magnificent Seven. And what's interesting is that we can look at there are ways to look at the S&P 493, and they've actually been flat so far this year. So all of the damage really has been in tech, and particularly in the Magnificent Seven. And I think you're right. A lot of it is people are kind of questioning the AI story. I don't think this is .com. I don't think this is the tech wreck that we had back in 2000. But I think some of the valuation hype or air has come out of these stocks, and that's another reason why I've lowered my numbers. I don't think we're going to go back to 22 multiple on the overall S&P 500 or a 30 multiple on the Magnificent Seven. It's already down to under 25.
Is this not necessarily the bubble bursting, but the bubble bursting in the sense that it really was a multiple story, not necessarily a tech story? Or can you see that maybe this is actually having to do with the fact that in China, they're making real inroads, and no longer is the U.S. so exceptional when it comes to some of the technological innovation as well?
Well, I think when it comes to AI, there's nothing keeping China or anybody else from coming up with innovations in that area. I think at the end of the day, AI is going to be a great productivity booster for the users of the technology. I think there's going to be so much competition to actually produce the large language models that, the Chinese are basically giving it away. So that really reduces the value of all that money that's being spent. And I think that's where the issue is coming in the market, is people are questioning whether the hyperscalers are really going to be spending all that money on data centers, and data center stocks have taken quite a hit. But I think you're right. I think the valuation really depended on a notion. It really depended on a roaring 2020 story. It depended on the idea that the economy wasn't going to have a recession, but this tariff thing really has changed that.
Let's see if we can get back on course. Ed, it's good to see you.
Thank you.
Appreciate your time. It's great to see you in person too. Ed Yardeni there of Yardeni Research, breaking things down. What's worked so far this year? Chinese tech, part of that story. Upending the US tech story at the start of the year with the DeepSeek revelation. What's working elsewhere? European industrials, financials. That capital sucked into Europe on the prospect of more fiscal stimulus. Just upending the US trade over the past few months.
There were two prongs to this, and Stuart Kaiser was talking about that. On one hand, you had the fiscal exceptionalism of some of the expansion of the U.S. balance sheet. On the other hand, you had tech exceptionalism, both prongs being challenged on two different fronts, both with cutbacks at the federal level as well as some of the challenges that we've seen over in China.
If you are just joining us, welcome to the program. Big challenge in the next 24 hours, expecting some major tariffs from the President of the United States. They will be unveiled in the Rose Garden tomorrow at the White House. We're told at 3 p.m. Eastern Time. Going into it, equities a little bit softer. We're down by 0.4% on the S&P 500. In the bond market, yields have been lower. They stay lower. We're down 5 basis points on a 10-year this morning to about 4.16. At the front end of the curve, the 2-year down 3 to about 3.86. Up next on the program, a record-breaking rally for gold. Why gold can go even higher. Francisco Blanch of Bank of America joins us next. Let's get you some price action. Equities right now near session lows, negative 0.5% on the S&P 500 after snapping a 3-day slide and a big decline this time yesterday morning by the time we got to a close. On the Nasdaq 100, we are negative by 0.4%. The Russell softer by 0.3%. The Washington Post reporting the prospect of 20% tariffs on most U.S. imports. We'll get to that story in just a moment. In response to that, that's your equity picture. Here's the bond market story. 2-year, 10-year and 30-year bond yield lower across across the board. We're down by 3 basis points at the front end to 385. 10 to down 5 to 415. Call it 416. And the headline of the morning, off air, Ed Yardeni headed towards the door. Throws this one out there. He's got gold at 4K year end. Did he say 5K year end next year?
That's what he said.
Wow.
And he's talking about the potential for people to continue structurally buying gold, both as a precious metal, but also as a hedge to volatility and potentially to the dollar.
All-time highs. We're up again this morning. More on gold in just a moment. We're 2 hours away from the cash open. Here's your morning movers with Yahara Hacker. Say Yahara.
Hi, John. We start with PVH shares soaring in the pre-market, up 15%. And while PVH might seem unfamiliar, it's the company behind well-known brands like Calvin Klein and Tommy Hilfiger. Well, the company gave a surprisingly strong forecast, impressing investors at a time when we know other apparel companies have issued warnings about the consumer and tariffs and bringing down their forecast. Next up, we have shares of Live Nation. Those are falling nearly 1.5% after President Trump signed an executive order cracking down on ticket scalping and those pesky fees that make attending live events more expensive. And at the president's side during the announcement was Kid Rock, who called out Ticketmaster, which is part of Live Nation. He accused it of profiting each time a ticket was sold and resold. And last up, we have Southwest Airlines. Those shares are falling nearly 3% after Jefferies downgraded the stock to underperform. The analyst we know well, Sheila Cayugo, is expecting softness during the summer months. She says swelling macro uncertainty will weigh on corporate and consumer sentiment. And in this note, she also says she expects Southwest, American Airlines, and Air Canada will have to cut their 2025 outlooks. John?
Tough few months for the airlines, that's for sure. Yahara, thank you. More from Yahara later this hour. On our radar this morning, our top story, a proposal to impose tariffs of around 20% on at least most imports to the United States. The Washington Post citing 3 people familiar with the matter. Trump is set to announce his tariffs at 3 p.m. Eastern tomorrow.
What I think we've been hearing a lot this morning, though, the situation is still fluid. This is one proposal, this maximalist approach. What I find interesting is what the Treasury Secretary said yesterday. Then people will be able to line up and maybe lower their tariff barriers, a.k.a. that leads into negotiation. There is something important happening today, and there's a question on whether or not it's going to be leaked or presented to the press as well. Jamieson Greer is going to go to the president, the USTR ambassador, the trade representative, with the report the president asked when he walked into the Oval Office day one in January. And that's to look at the trade imbalances for all these countries. Depending on what's in that report, that could dictate what we see tomorrow out of the Rose Garden.
Just an idea of what's going to be happening behind the scenes through the next 24 hours or so. A lot of lobbying as well. This, as we talk about US automakers making a last-ditch effort to push back on tariffs set to take effect this week. According to people familiar with the matter, telling Bloomberg, Ford, GM and Stellantis are pressing the White House for exemptions on low-cost car components.
And I think maybe they've got a chance because this was something that was inserted into the proposal late in some of the negotiations, and this is their understanding. The issue here is how do they deal with a situation where cars, the average price right now of a new car in the United States is about $50,000. Auto loans, serious delinquencies are at the highest levels going back to 2010. You've seen this being pushed back where suddenly car manufacturers have been trying to lower prices, not raise them. So how do you deal with cars that have low-cost components coming into this country? How do you make it so that you can break even as a car company while still keeping that price point at a place that people can afford it?
Trump, though, said yesterday, after he met with the Stellantis chairman, he told the press that, yes, that's true, I did meet with that individual. He said, I already gave the automakers a big break for this month. I think a key question for tomorrow is if you have plants, say, in Mexico and Canada at the minimum, if you're USMCA compliant, will that continue? These representatives, whether it's Howard Lutnick, Jamieson Greer, even Susie Wiles, the president's chief of staff, they are getting a flood of calls from not just automakers, but company after company asking for carve-outs and asking for exemptions.
It all comes down to one man, the president of the United States, at 3 p.m. in the Rose Garden at the White House tomorrow afternoon. Wanted to squeeze this story in. OpenAI finalizing the largest private tech funding round of all time. According to PitchBook, the company behind ChatGPT secured another $40 billion from SoftBank and other investors for a $300 billion valuation.
Before you take a look at this and say, see, actually the tech bubble is not a bubble and it's going strong, and there's a company that's raising money at twice the pace that it was as recently as October. Its valuation has doubled since then. pause, take a step back. This is a company that, A, is become completely integrated into a lot of different workflows, but 2, is restructuring itself as a for-profit after having had a non-profit overlay. Now they're going to have a for-profit section, and this could potentially expedite that type of monetization of some of their prevalence pretty much throughout.
Remember a decade ago we used to talk about billion-dollar unicorns?
Yeah.
$1 billion, 300 unicorns. Private market's amazing these days, isn't it?
It's a great point. And actually, this is the reason why increasingly Apollo is saying that there's no daylight between private markets and public markets. And if anything, why would OpenAI, to exactly that point, have to do an IPO, an initial public offering, if they're raising money like this in a private markets with things like Microsoft as well as SoftBank?
That's the latest on OpenAI this morning. Let's turn back to commodities. Gold continuing its record-breaking rally. Bank of America suggesting the precious metal could reach 3,500, driven by central bank buying and haven demand amid rising geopolitical and macro uncertainties. Francisco Blanch of Bank of America joins us now for more. Francisco, welcome to the show. A 19% move in the first quarter, the biggest quarterly gain going back to 1986. Francisco, let's talk about the drivers of the first 3 months of this year before we get into the next 9 months of 2025. What got us to this place?
Thank you for having me again, John. So I think gold has been really drifted up by essentially we started out with central bank buying in the last 3 years, but I think investors have started to accumulate it as well. So I think what's really changed has been more investor buying, whether it's through ETFs or other instruments, but also we are seeing asset managers and insurers starting to pile in. So that's been the change. Remember, we've seen a weakening U.S. dollar. We've also seen falling interest rates, at least on 10-year yields in the U.S. And that's kind of led to incremental demand for gold. Plus, of course, there's the issue of tariffs and the potential implications that may have in the economy. So I think all of that has come together. But gold's not alone. I mean, we've seen a big rally across the commodity complex. We've seen also coffee moving up. We've seen, we've seen silver. Actually, commodities are up almost 9% in the first quarter, John. I mean, it's been a really strong run, maybe a little bit of an unexpected run, and the sector has outpaced bonds and equities across the board.
Francisco, before we dive into just generally the commodity rally, how distinct is gold, given its hedge factor, as well as increasing concerns, as we were speaking with George Saravelos earlier, about diversifying away from the U.S. dollar?
Well, so I think there is an element here of diversification, no doubt. I mean, central banks are now holding about 10% of their reserve assets in gold, and that number is likely to continue to increase at an annual pace of 1% to 2%, probably as far as the eye can see. Remember, one of the things that the Trump administration is trying to do is to rebalance the U.S. twin deficits. And that rebalancing of the twin deficits, by definition, implies that there is a lower desire by the Trump administration to continue to supply this reserve asset that the world has been carrying for a long time, which is U.S. Treasuries, right? So if you reduce the deficit, if you reduce the budget deficit, if you reduce the current account deficit and the trade deficits, by definition, there's going to be less treasuries available for central banks around to hold. And then there's the whole sanctions and tariffs overlay here that's also driving the demand for gold.
So I guess that my question for you is, have we seen the bulk of it? Why isn't your target higher? You say 3,500 as your recent target. We were just talking to Ed Yardeni, who left the office saying 4,000 by the end of this year and 5,000 by the end of this year. And it seems like people can't get enough.
Well, I mean, there's a little bit of that right now, but also remember, gold is a pretty large market already, right? It's over $10 trillion in value. So of course you can put any number there because there's no such thing as intrinsic value in something like gold. I mean, there is of course a cost of production, but as we know, mining increases the stock of gold by 1.5% a year. But the real story here is how much investment can you drive in? Of course, gold could spike a little higher, but you would need to see a much worse economic outcome than what the market is currently pricing in our view, right? So it's going to be a steady grind higher as opposed to a big jump, unless something dramatic happens.
Francisco, there's a lot of research that all this has to do a lot with the uncertainty about the trade and the tariffs, that the announcement we're going to get tomorrow. But how much is it just driven by the fact that it is uncertain and most people are projecting the next year to just remain uncertain? So the safest thing is to just go into gold.
Well, again, just mentioned that earlier. It's a combination of factors. When you look at gold historically, it used to be rates, it used to be FX. But now we have this uncertainty, which is, of course, triggering the purchases. But again, the uncertainty is really impacting all investors across the spectrum. As I said, we are seeing retail investors, we are seeing asset managers and insurers, pensions, we're seeing also central banks. So, and again, is it the safest bet here? I don't know, right? But are we going to continue to see interest across the board? Most likely, yes. Now, what are the downside risks? Well, downside risks is that the Trump administration is successful at rebalancing its accounts, and we end up having a very strong U.S. economy with relatively limited deficit, and therefore the U.S. becomes a very attractive place to invest again, right? I mean, a big part of the rotation to gold is also related to the drop in equity markets, the drop in the Max 7, right? So let's say that we started to see again strong growth and strong rebalancing in the U.S. as a result of all these policies. Maybe gold isn't as attractive anymore in that context, right? So I think we also have to consider the downside risks, not just the upside risks. It's never going to be a straight line for any asset.
Francisco, I just want to finish on the availability of gold and maybe lean on your conversations with clients so you can avoid offering your opinion. Unless you've got one, by all means, share it. Do you think they're losing confidence about that gold availability in places like the Bank of England? Is that behind some of the speculative drive we saw into gold over the past few months?
I don't think there's as much like a confidence in terms of the stocks of gold being there. I think it's been more about the movement of gold to Europe into the U.S. ahead of potential tariffs. Remember, there's a lot of instruments in the U.S. that are issued. There are instruments that may have a gold physical backing. And if you've promised investors on any kind of note, whether it's a structured note or an ETF or some kind of fund, that gold is going to be physically available for the investor to take hold in the U.S., you're probably shipping gold out, right? Just in case that those tariffs go up and suddenly you face a big dislocation between the product in the U.S. and the product abroad. And to some extent, we've seen that in other commodity instruments like copper, and a bit less so in the energy space because it's a little more fungible. But investors are rushing to bring stuff into the U.S. ahead of this so-called Liberation Day tomorrow in the Rose Garden. So what is the impact of those tariffs going to be? Well, again, you'd rather have your product in the U.S. of A ahead of that potential price change because unlike currencies and unlike other instruments, commodities are going to suffer the tariffs directly, right? So it's a direct play on the tariffs, and you'd rather be in than out when those tariff walls go up.
Another record high over the past week. Francisco, appreciate your time breaking down gold. Francisco Blanch there of Bank of America. A record-breaking rally through the first quarter, the biggest quarterly gain we've seen going back to 1986. With an update on stories elsewhere this morning with your Bloomberg Brief, here's Yahara Hakes with more. Hey, Yahara.
Hi, John. Commerce Secretary Howard Lutnick could withhold promised CHIPS Act grants as he pushes companies to expand their projects in the U.S. Sources telling Bloomberg that Lutnick's goal is to generate tens of billions of dollars in additional investment without increasing the size of federal grants. He wants other chip makers to follow TSMC, which recently announced a new $100 billion investment in U.S. plants. Meanwhile, Amazon is bringing back metal detector screening for employees leaving its warehouses. The theft prevention measure was stopped during the pandemic. The company is also asking workers to register their personal phones. Amazon says the changes are aimed at making facilities more safe and secure. And in March Madness, the women's Final Four is set after Texas took down their cross-state rival TCU. They move on to face fellow number 1 seed South Carolina for a spot in the national championship. Elsewhere, UConn defeated USC 78-64. The win marks UConn's 16th Final Four in 17 years. They're set to face number 1 overall seed UCLA. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. More from Yahara later in the programme. You've gone quiet.
Well, I'm not doing well anymore. I had USC beating UConn, so
Gotcha.
that kind of stinks.
Lisa's not even playing. Neither am I.
Sorry.
Just to be clear.
It's like roulette.
Up next on the programme, turning the page on Q1.
The market now is laser focused on this tariff or trade issue. Expectations are probably not where reality is, which is that growth is worse than people thought, and inflation's a bit stickier. I'm not willing to throw in the towel yet completely on the full year.
Up next on the programme, John Bilton of JP Morgan Asset Management, live from New York. You're watching Bloomberg TV. Snapped a three-day decline in yesterday's session to close out Q1, but Q1 was brutal, and so was March for the Nasdaq and the S&P. The S&P is down by 0.5% this morning, just a little bit softer as we kick off Q2. Under surveillance this morning, turning the page on Q1.
The market now is laser focused on this tariff or trade issue. Expectations are probably not where reality is, which is that growth is worse than people thought, and inflation's a bit stickier. I'm not willing to throw in the towel yet completely on the full year because, as we've been saying, the good stuff of the policy changes that we expect could start to feed into the equity markets by year end.
So here's the latest this morning. The first quarter wrapping up with sinking sentiment and slashed growth outlooks. John Bilton of JP Morgan Asset Management writing trade wars, a pickup in inflation, or overly restrictive monetary policy prevent risk to our view. Nevertheless, we're optimistic that as policy trajectory becomes clearer, we will find opportunities to add risk. John joins us now for more. John, welcome to New York.
Thank you.
At the end of December, if I'd promised you 20% off some of the biggest tech firms on the planet listed here in the United States, people would have snapped my hand off. Are these companies still the same?
Well, broadly speaking, I mean, the trend towards, technology democratization, everything we've seen in the first quarter, the projects being initiated on AI, they're still there. This is a super trend. So, ultimately, you're right. And I think it's worth looking at the valuations. It's the biggest tech firms in the US are now 4 turns of valuation below their pre-COVID levels. So as a result, you are looking at a market which has cheapened up significantly. Tech probably is the top side risk to the S&P these days.
So if that's the case, why aren't you buying aggressively?
Well, because I think we've got to sort of take the index as a whole, and we've got to look at opportunities here and there. At the moment, if we look at the cyclical sectors and the rest of the S&P 500, actually stocks outside those top 6 are about a turn expensive to where they were pre-COVID. So if we put it all back together, then you get some ability to be able to pick out sectors and stocks. This is much more of a sort of stock picking market, I think, than necessarily taking a big macro bet on the market, particularly when we've got this kind of policy uncertainty around us.
Hold on a second. You just said that some of the cyclical stocks are getting expensive. People have been talking about a broadening out, a rotation into the wider S&P 500. Are you saying that's over?
Well, no, I'm not saying it's over. I'm saying we need a little bit more certainty about where the direction of policy is going. Right now, investors are sitting on their hands. We've seen some earnings downgrades coming through. So ultimately, I think what we need to understand is where the overall macro landscape is evolving too. At the end of the day, the US economy is still reasonably robust in our view, but it's cooling to some degree. And as a result, that's making it harder to make those earnings upgrades come through. But what's been hit really hard, of course, are those sectors that had driven the market last year and the year before. And those have gone through the hardest of the derating. So now we're actually looking at them and they're beginning to become attractive both in terms of their valuation, but also the quality of their earnings and their cash flows.
How nervous should European longs be going into tomorrow?
Well, therein lies the question, doesn't it? We've had Germany, obviously, pre-announcing a massive fiscal package, huge fiscal package. Could add 60, 70, 80 basis points to growth, on average over a decade. Thing is, it's going to take a while to ramp up. And of course, we've got tariff potential going the other way, which could take that straight back off the slate. So, if anything, when we look at where we are in Europe, we think we're perhaps a little bit over our skis. We're not going to chase this market. It's gotten expensive. So, we're about a turn and a half expensive in the European indices compared with the 5-year median valuation. And earnings, if anything, seem to be a little bit enthusiastic for where the economy is going just now.
So we back to the narrative that U.S. exceptionalism is back?
I don't think US exceptionalism ever went away. Let's be crystal clear here. The US corporate sector is the envy of the world. It's not just the idea of the economic policy. It may be true that the US is cooling some, rest of the world is doing a little bit more self-help. It may narrow the US rest of world growth gap. But the corporate sector, the whole ecosystem, the public-private market interaction, the innovation, the degree of governance within US corporates and the quality of cash flows still remains exceptional in our view. It's simply the case that it may have been overpriced relative to opportunities in the rest of the world. So there's still great opportunities to pick alpha, pick good stocks, pick good sectors, and I don't think that's gone away.
Is there a sector, though, that comes to mind that's not going to be hit potentially tomorrow, or the retaliation of what we might get tomorrow?
Well, I think we're getting to a point, and we've got to look also at sectors which perhaps have really priced in an awful lot of bad news. If you look at some of the capex surveys within the US, we're now down at levels which we were at around about the COVID pandemic. Corporate confidence, it's very, very low. Corporates are not over their skis. Capex plans have been put on ice. So effectively, you've got firms sitting on their hands. As mentioned earlier, we still think that tech has really derated a good long way. These are still good quality companies generating huge amounts of cash. I think the financial sector looks reasonably good. We quite like utilities as well. So there are a number of areas where we see opportunities. And I think that's really going to be the signature of this year. Rotation's not dead. It's just not necessarily going for growth at all costs. It's looking for resiliency, quality of cash flows, etc. And that's, I think, what is going to come to the fore.
I feel like people are also falling in love with bonds again. And I'm not talking about treasuries, but credit in particular. I hear that a lot, that you want income and you can get it. You can get 7.7% on high yield bonds at a time where that's a steady cash flow. Sentiment's cratering, but cash flows aren't. Is that kind of where you are too?
In many regards, we've been in credit now for quite some time, seeing it as a really good diversifier to equity. Different set of sectors, different set of exposures. You're playing the balance sheet, not the income statement when you're thinking about credit. And the US right now, we're talking about growth. We're not really talking about the balance sheet. The US looks pretty solid. If we look at the consumer balance sheet, the financial sector, corporate sector, it's all fairly strong. And as a result, we think that the credit is quite resilient. We're not seeing the US in a position where it collapses into recession. We're seeing the US as an economy which is cooling down to a period where we've got a bit of sub-trend growth. Corporates sitting on their hands, consumers sitting on their hands. As a result, credit looks pretty good. A good way to just be clipping the coupon a little bit higher up the capital stack.
John, 20 seconds. What's the biggest difference right now between conversations you have in Europe and conversations you have in New York in the past 2 weeks?
Folks have just suddenly rediscovered the region they live in. All of a sudden, it's not dead money anymore. And people are asking questions. Yes, it's expensive now. Cash flows maybe not as strong as they could be, but folks have realised it's still there on the map.
It's a major change. John, it's good to see you. It's great to catch up. Thank you. John Bilton there, JP Morgan Asset Management, on some of the changes we've seen in Q1 and what you can look for in Q2. In the third hour of Bloomberg Surveillance, up next, we'll catch up with Emily Roland of John Hancock, John Lovallo of UBS, Tiffany Wilding of Pimco, and Tom Tzitzouris of Strategas. The big days tomorrow, big tariffs coming for the President of the United States. Equity futures on the S&P near session lows. We're negative 0.5%.
If we break down this week and universal tariffs are the reason, we could see something even lower than 5,500 in the short term.
There probably is still, to some degree, a level of a correction coming. There may very well be more to come.
The market's trying to find a bottom. Things will recover.
Markets are down. It's not just a rotation underneath the surface.
I've sensed this bearish sentiment on the rise, especially in the last few weeks.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The opening bound 90 minutes away. The third hour of Bloomberg Surveillance starts right now with equity futures declining by 0.5% on the S&P. The Nasdaq 100 looks like this. We're down across the board here by 0.5% on the Nasdaq, by 1/3 on a Russell. Elsewhere, your day ahead looks like this. Later on this morning, ISM manufacturing and JOLTS job openings. Look out for that alongside the ISM. Of course, we'll hear from the President of the United States later on this afternoon. Then when we get into the rest of the trading week, you'll get more data data, ISM services, jobless claims and payrolls. This morning, though, we start with this report coming from the Washington Post and this headline right here. White House aides have drafted a proposal to impose tariffs of around 20% on at least most imports to the United States, according to 3 people familiar with the matter. The situation, as we've said repeatedly, is fluid. One man gets to decide, the President of the United States.
The 20% tariff rate would be the maximalist approach. We've heard from a number of different investors and analysts. Key question about if this is a starting point, where the negotiations are going to be, how long this is going to draw out, and frankly, whether there is going to be some sort of damage in the meantime. You have, for example, Goldman Sachs now seeing a 1 in 3 chance of recession with a 15% tariff rate. This would be materially more, something that a number of firms have come out and said would ensure recession.
Right now, what you have is peak competing interests within the White House. I look at this report, 20% across the board for revenue raisers to offset, potentially give a tax rebate to the American people. This sounds like one camp, a very maximalist camp when it comes to trade, the likes of Peter Navarro. Last night, we heard from the Treasury Secretary, and he was asked about this. Of course, he didn't want to get ahead of the president, but Scott Bessent said everyone will then have the opportunity to lower their tariffs, lower non-tariff barriers, stop FX manipulation, basically saying this is the beginning of a negotiation, not the end.
Is that how the Europeans see things? Ursula von der Leyen, the European Commission President, saying we do not necessarily want to retaliate. If necessary, we have a strong plan to retaliate, and we will use it. Let's see how quickly they plan to deploy it.
We've seen this pretty much repeatedly. Even Canada, you have, just coming out and saying, Mark Carney, our relationship, which has been in place for 100 years, is now changed. And you've heard that pretty much across the board. Are these just hard words? Have they tried to negotiate with the president? How do they get leverage heading into negotiations that could drag on for a long time? But more important, the uncertainty is not going away. And that is the reason why people are factoring uncertainty into their forecasts and into their valuation models.
Another price target cut on the S&P 500 overnight, this time from Ed Yardeni. Ed Yardeni does it twice. He says the expected fallout from Trump's 2.0 reign of tariffs undercuts our former bullishness and dims the prospects of our base case roaring 2020s scenario.
He still sees roaring 2020s as in effect, but dampened significantly based on some of what we have seen with respect to the tariffs. The speed of which people have downgraded. We talked about this with respect to Goldman Sachs, David Kostin, twice in 1 month, just with a couple weeks in between with downside expectations. This is something that people are grappling with at a time when uncertainty has a cost and conviction has a cost. And I will just say the data that we get today, ISM, is going to be very interesting because manufacturing is supposed to go lower and then prices paid expected to go higher. And that's not what people want to be seeing.
We can still end up in a good place. A lot of equity market bulls have said the same thing. When we spoke to Ed Yardeni still sees stocks higher at the end of the year, but the conversation has to move away. We were talking to him about this. I've never seen sentiment this week collapse this fast outside of a recession. The hard data has barely moved just yet. We get more hard data later on in the week. But you can see the conversation being pushed along down in Washington towards taxes. Secretary Bessent only in the last 24 hours talking about no tax on tips, on Social Security, on overtime. We're going to make purchasing an American car tax deductible all over again. That's the effort down in Washington.
The sweeteners to offset this. The problem with that is you've got to get it through Congress, and then there's a bill associated with it. And even the bill that they have right now, the tax bill, has a $4 trillion expansion of the deficit over the next 10 years. There is an upside, though, which is the reason why it's a tale of two halves that a lot of people have been talking about.
Sequencing was always going to matter. What would they start with? And they started with, in the minds of this market at least, in the opinion of investors, they started with the negative stuff, and the positive stuff could come later this year. Equity futures on the S&P 500 negative by 0.5%. Coming up this hour, we'll catch up with Annmarie Roland of John Hancock with 1 day until the big tariff announcement. John Lovallo of UBS on the headlines, headwinds facing home builders, and Tiffany of Pimco on threats to U.S. exceptionalism. We begin this hour with stock steady as traders await President Trump's reciprocal tariffs. Annmarie Roland of John Hancock writing, there is still a broad-based global economic cycle that will drive earnings and valuations on stocks overall. This cycle may be borrowed time as recent economic does start to show cracks. We would consider further pruning risk in portfolios. Annmarie joins us now for more. Annmarie, welcome to the programme. We've seen some major moves in this stock market through the first quarter. Do you see some big opportunities opening up now?
Yeah, John. So we are actually going to be moving to neutral on U.S. large cap equities and actually allocating those assets to credit. And really, it's not necessarily about the policy uncertainty. It's really just about the starting point. U.S. stocks have handily outperformed credit really since the stimulus boom in response to COVID. And we've seen a couple of exceptional years where earnings have been phenomenal. We've seen massive multiple expansion, back-to-back 25+% returns for the S&P 500. So we're looking to where we can prune a little bit of risk off the top there. And global equities are really what's benefiting from this rotation. It is amazing to see what the leadership has been. It's German industrial companies, it's European banks, it's Chinese technology companies. That's a really odd mix in our mind, especially as we think about the potential for tariffs to create this negative growth environment. We would actually be looking to look at income as a more important component of a portfolio than capital appreciation. So we're actually looking, again, to go neutral on credit and neutral on U.S. large caps.
You mentioned the outperformance we've seen abroad, the outperformance we've seen in places like Europe. Emily, do you think some pain might be in store for some of those European longs going into tomorrow's announcement?
I think they could be challenged just because of the velocity of the move that we've seen there. Again, if you guys remember that Sesame Street show where it was like one of these things is not like the other, that's what we keep thinking about as it relates to the cross-asset performance profile in the wake of this policy uncertainty. U.S. small cap stocks theoretically should be benefiting from the potential for these America First policies. We should see the U.S. dollar strengthening theoretically. That's not happening. Instead, we're seeing this massive sentiment-driven rotation into these cyclical areas of the globe. Typically, cyclical assets should do best coming out of a global economic downturn, and we're actually seeing them outperforming in a late cycle environment. So I think that sentiment could shift rapidly here. We have to remember that this is a global economy. If U.S. exceptionalism is at risk, if U.S. equity exceptionalism is at risk, broad equity exceptionalism here is likely at risk as well, which is another reason we think that income is going to be a more important return driver than capital appreciation.
Emily, that is the line that I want to pick up on. If U.S. equities have lost their exceptionalism, the rest of the world's equities have also lost their exceptionalism, which is a reason why you see a good place for income-producing assets. I wonder, do you see bonds as actually outperforming equities this year amid this focus on income and not necessarily equity premium?
Yeah, we do actually, Lisa. And some of the reasons that we've, made this decision is kind of just thinking about that potential. You mentioned before, U.S. high yield bonds are yielding almost 8%. Yes, there may be some spread widening. So we've come off the lows of about 250 basis points over treasuries to a little bit over 300 now. Maybe could see a bit more spread widening here, but now the income is enough in our view to overcome that. You look at standard deviation over the last 10 years for the S&P 500, about 18. We're looking at about 5% standard deviation on high yield bonds. And then finally, looking back over the last decade, the maximum drawdown that we've seen in stocks is about 33%, and it's 21% in high yield. So it's not that we love credit within the context of fixed income. We actually still have an overweight to higher quality bonds over credit, but within the entire portfolio, we think being able to maximize or to minimize drawdown, to be able to lower standard deviation, and to be able to get nearly an 8% income on high yield is a decision that makes a lot of sense.
Emily, when we started the hour, John talked about how sentiment's never been lower, at least not in the recent past, even though we haven't seen an even bigger bear market in broader stocks. And then I started to list off this recession call, this person is downgraded 5 times. And I was thinking to myself, I sound really bearish and I sound as though we're heading into Armageddon. And is that a contrarian indicator? The idea that we have discussed all of these worst case scenarios at a time where the consumer's balance sheet is still pretty good. You do have companies that are still performing okay. Is there a sense that maybe we've gone too far and equities can reverberate back, especially led by big tech?
There is. I mean, at the end of the day, it's not that bad as it relates to the hard data. We watch things like initial claims really closely on Thursday mornings. We've been in the low 200,000s. There are some cracks forming there. Continuing claims are elevated. We've seen job openings slowing. We'll get another read on that this week, but the hard data are holding in really well, especially as it relates to the labor market. The challenge is the soft data is horrible. Consumer expectations hitting a 12-month low, University of Michigan sentiment index declining. You all have talked a lot about that on the show. We've got to be mindful of that. First of all, that soft data just soared after the election. We saw just massive optimism, things like home builder sentiment, NAHB. Again, some of the sentiment surveys around expectations soaring, especially on the Republican side. But we've seen a little bit of a give back there. And then we also have to remember that businesses and consumers sometimes say one thing and do another. I think durable goods coming in solid last week was another example of that. So we've got to be mindful. I'm not saying completely ignore the soft data, but we're watching the hard data for signs that a contraction is happening or something more nefarious is going on, and we're just not seeing it.
Emily, appreciate the update. As always, it's good to see you. Emily Roland of John Hancock. Sentiment has almost collapsed over the past few months. This hard data really has not. Maybe it will follow the survey data. Payrolls is going to be a monster data point for us on Friday morning at 8:30 Eastern Time. A sneak peek of our survey, 140 is the median estimate for Friday for headline payrolls. Then, Lisa, later on in the afternoon, you'll hear from Chairman Powell for his view going into the weekend.
And this has become a trend. He likes to come out and discuss something, message something, even though he then says, I have nothing more to say because, frankly, I'm in a black box with a blindfold, just like everybody else. I will say one hard data point that is showing some signs of what we're seeing in the soft data has been the ISM services and manufacturing data. We do get manufacturing today, and maybe more than any other indicator right now, you are starting to see that stagflationary feeling come into the hard data. That is what I'm watching. The jobs picture is going to be muddy and backward looking, and people will dismiss it. But you're going to see some of these other soft metrics or hard metrics start to shift just a little bit.
More survey data a little bit later. Equity futures right now in the S&P negative by 0.5%. With an update on stories elsewhere, here's your Bloomberg Brief with Yahara Heckes. Hey, Yahara.
Hi, John. President Trump said his first trip this term will likely include visits to Saudi Arabia, the United Arab Emirates, and Qatar. Trump added that it could happen next month, and he'll likely make additional stops. His remarks come after Axios reported that White House officials were planning Trump's first trip to Saudi Arabia in mid-May. Meanwhile, President Donald Trump signed an executive order aiming to crack down on ticket scalping and fees that drive up the cost of attending live events. The order is similar to former President Joe Biden's move that targeted junk fees and pushed transparency in ticket pricing. And Goldman Sachs has drawn more criticism for the $80 million bonuses it plans to give the bank's top two leaders, David Solomon and John Waldron. Institutional Shareholder Services, a proxy advisor, is urging investors to reject the rewards at an annual meeting. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate the update. More from Yahara later on this hour. Up next on the programme, the Morning Calls Plus, John Lovallo of UBS as home builders brace for reciprocal tariffs. Those tariffs drop tomorrow. Live from New York, this is Bloomberg. The opening about 1 hour and about 14 minutes away. Equity futures down by 1/3 bouncing just a touch going into the cash open. We're lower here by, let's call it 1/4% on the Nasdaq 100. Let's get you some morning calls. First up, Jefferies downgrading Southwest Airlines to underperform, citing uncertainty around consumer and corporate spending. That stock is down by 2.4%. Your second call from Melius downgrading Kroger to sell, pointing to competition from Walmart and a C-suite transition. That name is down by 0.9%. And your third and final call, Morgan Stanley upgrading Dr. Pepper to overweight, highlighting the company's growth potential. That stock is just about unchanged in the pre-market. Let's turn to the home builders. John Lovallo of UBS seeing a challenging backdrop ahead, writing the housing industry faces numerous headwinds this spring selling season, including choppy demand, volatile mortgage rates, potential cost pressures from tariffs and immigration reform and Doge layoffs. And John, the list seems to go on and on and on. It's good to see you.
Good to see you.
How does this get any easier anytime soon?
So, look, I don't think the picture is all that dire. There are a lot of challenges out there, tariffs being kind of front and center. But if we think about the numbers behind tariffs, maybe to start, about 7% of goods and I'd say materials and sort of equipment that's used in residential construction is imported. So it's a relatively small number. The National Association of Home Builders has said that about $9,200 in cost per home. If you think about a home, the average price is $415,000. So that would be about an 8% increase in material prices, probably closer to 9%. It can be offset by about a 2% increase in price. We think that the pain gets shared across the value chain. So it's going to be the manufacturers, the distributors, and the home builders. So it's not all going to be shouldered by the home builders. So I think the way we've been kind of framing it is that tariffs are not good. Lumber is the biggest impact. 25% comes in from Canada. But it's likely manageable across the value chain.
So you think we have the lumber capacity in this country to go forward with residential housing without getting Canadian lumber?
It's a great question, right? If you think about the U.S. Lumber Coalition estimates that we could handle about 95% of capacity that's coming in, domestically. The capacity, the utilization rate in the U.S. right now is around 65% for the mills. So the 25% that's coming in from Canada could likely be resourced. Now, that doesn't mean that there's not going to be some cost pressure.
Okay, so there's cost pressure when it comes to tariffs, although it could be offset in terms of who bears the brunt of it.
Right.
At the same time, most economists seem to think that a lot of the tariffs on the table here will slow growth in the United States. And that might be the biggest headwind to the housing market, with housing stocks down 7% so far this year. How do you factor that in at the same time that you've got these cost pressures?
Yeah, no, it's a great question, Lisa. Look, I think that is the biggest risk, is that the economy slows, the consumer fades even more. And look, I mean, buying a home is the single biggest ticket item you're going to purchase in your lifetime. And so I think to the extent that the sentiment really sours, it's going to be pressure. There's no question about it. Now, that being said, there's still a structural kind of shortage of homes out there. There's underlying demand with demographics and all that kind of stuff that could be an offset.
What's sort of a strange conundrum for me is when I look at the housing stock that's been created post-pandemic, it's in very specific areas. It's in the Sun Belt. And now you're starting to hear about inventory overcapacity in a couple of areas where suddenly prices are actually going down. You're not seeing the same kind of demand at the same time that there might be a lack of inventory in other areas that didn't get built up during the pandemic. How does that complicate the picture?
Yeah, it's a tricky situation where I think that if the four big markets where there's been inventory build are sort of in the I-4 corridor in Florida, so between Orlando and Tampa. That our channel checks would suggest has actually started to get worked down. So it's in a little bit of a better situation than it was. Phoenix was another kind of MSA that was challenged. That's improved pretty dramatically. Austin remains a bit soft. There's still a lot of inventory, some price realization that's going on there. I'm not saying it's a perfect situation, but it does seem like it's getting incrementally better. Now, if demand were to slow further, you could see that inventory build up again. And we still have some work to do.
If we go back to the tariffs, because they're weighing on the market for tomorrow, we talked about Canada. What about Mexico? Because a lot of home builders have diversified away from China, but they're still very reliant south of the border.
Yeah. So I think, to frame it, I would say from Canada, lumber is the big deal. 25% comes in from Canada. In terms of Mexico, the big sort of import would be gypsum mineral that's used in wallboard. So that is something certainly to consider. A lot of our companies have exposure in Mexico in one way or another, so it will be an impact. China, from a home building standpoint, is largely appliances and some materials that are used in plumbing fixtures.
Can they make up those supplies in Mexico in the United States?
It's going to be challenging. I think that there are ways to offset some of those cost pressures for sure. And again, I think that the customers being so big, the home builders, that there will be some pushback that they'll be able to kind of put into play. But look, I mean, these cost pressures are real. I'm not trying to sort of poo-poo the tariff situation.
One feature of our conversation so far this morning is just how much consumer sentiment has been hit.
Yeah.
And how much consumer sentiment has been hit outside of a recession. Have you ever seen it like this before?
I can tell you that this is the worst that I've seen sentiment from an investor standpoint relative to our group. It's pretty bad, and I would say from a consumer standpoint, it doesn't feel great either. Now the consumer still feels like it's in reasonably good stead, but that could change. And it's at the biggest risk, as Lisa was talking about, is that if the consumer sours further, all bets are off.
Is sentiment a leading indicator or a lagging indicator at this point?
It's a good question. I think it's. Here's the cop-out answer. It's a bit of both, right? I think that there are certainly lagging aspects of it, particularly as it pertains to inflation. But I think that there's always somewhat of a forward-looking element as well with people.
So I'll lay out the concern that I have right now as a homeowner. Yeah. I'm sorry, it's going to get a little personal. But I'm looking around and I'm thinking the home builders did really well during a period of time where there was absolutely no inventory whatsoever because no one was selling because mortgage rates were too high. What happens if mortgage rates, long-end rates, fall significantly because of some sort of downturn and suddenly there's inventory and lower rates, but at the same time, people can get homes that previously were in existence? Mm-hmm. How much does this undo the odd pop that we saw in home builders immediately post-pandemic that was completely unexpected given how much rates went up?
It's interesting. Look, I would take lower rates all day long, even if it brings inventory into the market. It just broadens the pool of buyers that can actually enter the picture. Now, keep in mind, too, that the inventory that's out there, the housing stock in the U.S. is old. It's over 40 years old. It's generally at price points that are not most attractive to the first-time buyer that's very active in the market today. And so I think you have to look at actual inventory and sort of desirable inventory. And there's a big difference between the two. But even if all that inventory did come back, lower rates is just better for housing. The existing home market is at a standstill. We're at just over 4 million units. That should be 5 million or 5.5 million units. So it's a dysfunctional market. We need that to improve, and that would help all of housing.
In sum, you're bullish?
We are still bullish. We are, yeah. And believe it or not, look, I think that the stock's trading at 7 times earnings and, close to book value. A lot of this bad news is factored in our opinion. And generally speaking, when it's the scariest out there, it's the most attractive time to get involved.
Elisa's looking for recessionary interest rates to make the housing market great again. That's about as bullish as Lisa.
No, I'm actually wondering, will it make the housing market great again if people don't have the confidence? I don't know. I'm not talking my book. I'm just speaking my anxiety.
You're looking to move?
No,
She's locked in on 3%.
Okay, look, we don't need to get into my situation.
True. Maybe she wants to upgrade.
Okay, all right. All right, let's move on. Really, I'm just saying.
A little bit.
It's just really strange that we saw interest rates really high, but valuations didn't go down.
It's been a bizarre dynamic over the past few years, that's for sure. John, it's good to see you. Thank you, sir. John Lovallo there of UBS. Up next on the programme, we'll catch up with Tiffany of Pimco. Talk to her about interest rates and the economic data still to come this week. It's not just about tariffs. We've got payrolls on Friday, and you will hear from Chairman Powell going into the weekend. We'll also speak to Tom Tzitzouris of Strategas, a bad company, and what's happening with fixed income. What's happening this morning? Bond yields are lower by 5 basis points on 10s to 4.15. In the equity market, we're lower too by 0.5%. From New York City, this is Bloomberg. 60 minutes away from the opening bell with equity futures down across the board on the S&P 500 negative by 0.5%, on the Nasdaq 100 down by 0.4. In the bond market a bit again, yields lower across the board on a 2-year, 10-year, 30-year. We're down 5 basis points to the long end on 10s to 4.15, on 30s to 4.52. Later on this morning, 10 a.m. JOLTS job openings and ISM manufacturing. Just how much weakness will we see in the data going through the week?
And not just weakness, but at the same time, an inflationary impulse still there, kind of reiterating what we've seen in some of the sentiment surveys with ISM manufacturing. The index level expected to come down, prices paid expected to go up.
Let's finish on foreign exchange. Euro dollar pulling back south of 108, 107.91, negative by 0.2 of 1%. Pimco releasing its latest cyclical outlook, writing the following: at a time of sweeping geopolitical change and clear challenges for riskier assets, bond markets offer a source of stability. Tiffany Wilding of Pimco joins us now for more. Tiffany, a port in the storm. Let's talk about the storm, and the epicenter of that storm, as you and the team have indicated, is the United States and US policy. How dark are those clouds going to be tomorrow afternoon at 3 p.m.?
Well, I think just taking a step back, I think it's been incredibly clear what the Trump administration is trying to do. I think what's less clear is just that amid the constraints, political, legal, economic constraints, how much disruption are they willing to tolerate? So we would argue that the three things that they're most focused on are reducing the trade deficit, reducing the federal government fiscal deficit, and of course, returning the middle class in the United States from its current hollowed out place. Now, those are structural issues that require structural changes, and the lever that the administration is pulling is increasing tariffs. So, they've been much more aggressive at every step of the way than I think most people expected, anyone expected. And we think tomorrow, similarly, we'll get an announcement that, has a similarly aggressive increase in average effective tariff rates in the United States to levels that we have not seen since the 1930 Smoot-Hawley Act.
Tiffany, do those levels stick, or is this the beginning of a negotiation?
Well, you have to believe this is the beginning of a negotiation. Obviously, there's a lot of uncertainty around that and how ultimately that plays out. But I think we really just don't have a good sense because we haven't seen this type of shock, in quite some time. Obviously, global markets are much different now than they were in the 1930s. It's difficult. There's the potential for what economists call, quote, non-linearities. Supply chains are much more integrated these days. And we saw that during the pandemic as well. And so I just think there's a lot of uncertainty around the economic effects if these things stick. And as a result of that uncertainty, by the way, we've argued that the bond market is a place where investors, can look to seek some stability in terms of their outlook for returns.
How do you start to think about what potentially this could look like when you start to look at each country and their retaliatory measures they may take on the United States?
Yeah, so this is certainly a multifaceted game, and that's, going to play out, over the course of this year. Now I think it's not only, the other countries' willingness to tolerate, some economic pain. Global uncertainty and trade uncertainty will impact every economy, but it's certainly on the U.S. side as well. Our economy, the U.S. economy is, as you mentioned, it's kind of ground zero for all of this. We've already seen, a deterioration in both consumer and business sentiment. I would argue that one of the reasons why the administration won was because people were, the price level adjustment that we've seen over the last several years. People are wanting a reversal of that. Obviously, we'll get more of that price level adjustment, some more temporary inflationary pressures as these tariffs are passed on. So I think there's some real political questions around how much or how long, the U.S. administration can tolerate this. And so I think that all of that, again, just creates a lot of uncertainty on ultimately how this will play out.
Tiffany, I want to pick up on something that you said, that you see fixed income as sort of a port in the storm, or something that could perform better than equities over the near term and potentially even the medium term. You wrote, markets are in the early stages of a multi-year period in which fixed income can outperform equities while offering a more favorable risk-adjusted profile. Can you explain your thinking at a time when some people are worried about stagflation, the idea that inflation could really pressure some of these yields and actually make a complicated picture for bond investors too?
Yeah, well, ultimately, starting yields within the bond market, high quality bonds are a very good indicator of where the 5-year returns can be. And just starting yields are actually quite attractive now, relative to, call it the last 10, 20 years. And so you can construct portfolios, with yield levels that are, kind of historically in the range of where average equity-like returns are. Then against that, you look at various measures of U.S. Equity valuations. You kind of pick your favorite one. Equity risk premiums is something that we like to look at. It's relative to bonds, and you just don't have, it's very tight, looks very expensive. So we think even relative to its own history, relative to other asset classes, you can look to the bond market here. And I think the other thing is just within bond markets, diversifying and looking for opportunities outside of the United States, high quality areas within EM, for example, where you have a macro backdrop that is, also favorable for the bond market. That can provide a lot more stability and return potential. And if we do get a downturn in the United States, we've heard a lot about recession risks rising. You expect your bond portfolio to provide a pretty good hedge. So the bond market right now is sort of paying you for stability.
So in other words, you're saying that you don't see equities performing better than 4 to 8% on an annual basis for the foreseeable future?
Well, when you have starting valuations at these levels within equity markets, historically you have lower return potential, and again, and there's a wide distribution around those outcomes, right? It's less certain. Whereas, starting yield levels within the bond market, you're pretty certain that you're going to get that over a 5-year period.
Tiffany, always great to hear from you. Tiffany Wilding there of Pimco, up early for us on the West Coast. Let's continue the conversation now. Tom Tzitzouris of Strategas, a Baird company, joins us now for more. Tom, good morning. A once-in-a-generation type of discussion in the United States. That's what you're calling this. Why is it that big, that important?
Because, in my opinion, and this is not, as far as I know, the stated goal of the administration, but if these tariffs come in as expected tomorrow, and potentially there are retaliatory tariffs and there is a global trade war, then we're talking about really a shift away from consumption and towards savings, particularly centered in the U.S. And the U.S. consumer has been the global consumer of last resort. So this is a complete paradigm shift if those tariffs come in as expected and as televised.
It's a massive rebalancing. What does it mean for treasuries?
Well, a lot. But by the way, I would absolutely agree with Tiffany's comments that despite a lot of volatility in the economy, treasuries and high-quality corporates as well should be kind of a safe port in an otherwise stormy environment. But what we think is it's going to lead to still some yield volatility, but you're being compensated for that. So I think it means that for now, you're talking about a flatter curve as the Fed kind of holds tight and doesn't want to cut just yet, but eventually curve steepening.
What if that storm reigns stagflation?
Well, then you're probably talking about a flatter curve for longer, but at higher levels. And that's
So the whole curve shifts up.
Exactly. And which, by the way, to Tiffany's point, that's one of the reasons why you can do things with your bond portfolio to adjust for that and to accommodate that now that yields are already higher.
Are we pricing in the slowdown, not pricing in maybe some of the growth aspects, the things of the second half that will spur some sort of growth while also continuing inflation?
I'd say yes. Unfortunately, part of the problem is we don't know what those things are that could spur inflation in the second half, retaliation on tariffs. We also don't know what tax cuts are going to look like for 2026, which could be a big impulse for the consumer again and for businesses. So a lot of those are really uncertain until we get through this tariff discussion.
As Tiffany was talking, I was thinking about the idea that suddenly going into bonds at the same time that you have countries around the world engaging in a fiscal outcome, right, trying to borrow more to stimulate their economies. It raises the question, when does that type of paradigm shift as well? The idea that you can buy bonds as a haven, if that is some of the source of volatility and the source of leverage for a lot of different economies.
Well, and for terms of portfolio construction, what this probably means is as a standalone portfolio for income generation and capital preservation, bonds work. As a beta balancer against the volatility in your equities, they may not work as well. We've seen that the last few days as equities have been off again, and you've seen bonds rally, but not a huge, kick from bonds. So you're not getting that beta offset from bonds. That's really what it means.
We've been flirting with this idea for a number of months now. If you have the source of volatility in the government bond market, that is the real question here, the fiscal sustainability of the United States, this question of policy uncertainty. Could we be entering a period where high-grade corporate bonds end up trading inside government debt?
It's a tough call. Folks have been arguing for that for 100 years, and it still hasn't happened yet. There's a lot that has to happen, especially when you're the global reserve currency for corporates to trade tight to treasuries. I honestly don't see it happening in any sizable way.
When it comes to the tariffs tomorrow, What do you think is the end goal? Is it revenue raising or is it deal making?
Both.
How? How can it be both?
Well, because revenue raising, because we've got this expectation of tax cuts next year, which is really a big part of the Trump administration's promises, campaign promises, making the tax code fairer for the average American. So that is a primary goal. But obviously, in the short term, there is a goal on getting fairer trade deals and getting our allies to move in line with a strategy, a global geopolitical security strategy. So I think for now, the primary goal is just to see what the reaction is from our trading partners and to get essentially concessions from them. Longer term, it is to see how much we can actually extract in terms of revenue. So that will help to provide a baseline for what the tax cuts will be next year.
So the first case is deal making, and then whatever deal you don't strike, then you revenue raise. Is it going to be enough revenue raising, though, to get the kind of tax cuts they're talking about? I'm not talking about extension of TCJA. I'm talking about all the extras the administration has been adding on.
Very likely no. But that doesn't mean they're not going to try.
So you think they go through with it and they were able to get some of those sweeteners?
I think so, yes. I think this will provide a substantial offset to the tax cuts, but I don't think it's going to completely offset those tax cuts in terms of revenue lost.
Hey, Tom, good to hear from you. Tom Tzitzouris there of Strategas, a bad company. The latest on the consumer. This from Neil Dutta of Renmark just moments ago. Consumer spending doesn't have anything really going for it right now. And if the US consumer does not have a lot going for it right now, the US economy doesn't either. Goes on to say the weak growth in consumer spending nearly ensures a below potential growth environment.
He points to the fact that retail gas prices have been climbing. He talks about job openings, which we're going to get at 10 a.m., at least from the JOLT survey. Continuing to slide, he points to Indeed.com and how job postings have been falling to a year-to-date low. These are some of the indicators people are looking at to get a sense. My question to Neil, and I'm sure, and I missed him yesterday, I'm sorry.
Neil's watching, so
Neil, I guess that my question to him is, does he think that the Fed should respond to this? Because at a certain point, if it's a stagflationary concern, what Neil's been arguing for is for the Fed to cut. But how do you get ahead of something where the pressures are incredibly different than they have been in the recent past?
Richard Clarida, the former Fed vice chair, was on the programme with us a little bit earlier this morning. He basically said they'll be late because they don't want to be too early. That speaks to what you're talking about right now. They're not going to step in, conditioned by what happened in 21, 22, his view. Because they're conditioned by that, they're going to wait to make sure they get this right.
Especially given the fact that expectations among consumers has been climbing for longer-term inflation. They don't count University of Michigan, okay, but there are other surveys that indicate, in particular from CFOs and CEOs, they expect to raise their prices with slowing growth. It creates a real challenge for a Federal Reserve that has ostensibly a dual mandate.
Neil has been arguing that they should be cutting because when the Trump administration came in, the economy was already weaker, and that what you hear now from a lot of people is that they're just using tariffs as this latest excuse of basically what he says was already there and underlying issues with the economy.
JOLTS data drops then later on this morning at 10 a.m. I'll tell you the data point I'm looking for. It is a bit dated. It's February data. It always is a bit dated when we get JOLTS, but I'll be looking at the quits rate because the anxiety around unemployment is captured in the surveys that we've seen from you, Mitch, from others as well. And if you're feeling anxious about higher unemployment in the future, are you quitting your job? The answer to that would probably be no. So let's see if that drops as well in the next couple of hours.
And if that does drop, it'll just add to this feeling the labor market isn't quite as tight as people previously thought. On one hand, inflationary pressures, that diminishes on that side. On the other hand, if you're looking for a slowdown, that adds to your case.
The big data point drops this Friday. Payrolls at 8:30 Eastern Time. In our survey, 140 is the median estimate at the moment. That can change as we get more estimates, but 140 is the median at the moment for Friday morning on a headline basis at 8:30 Eastern Time. Equities at the moment on the S&P negative by 0.5% with an update on stories elsewhere. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Treasury Secretary Scott Bessent said he's working with House and Senate Republicans to make the extension of President Trump's 2017 tax cuts permanent. Speaking to Fox News, Bessent says he's also working on the cuts President Trump promised during his campaign, including no taxes on tipped wages, overtime pay, and Social Security payments. U.S. automakers are making a last-ditch effort to push back on tariffs set to take effect this week. People familiar with the matter telling Bloomberg Ford, General Motors, and Stellantis are all asking the White House for exemptions on low-cost car parts. And SpaceX launched a mission funded and commanded by cryptocurrency investor Chun Wang to fly over the Earth's polar regions. The mission, carrying a crew of 4 private astronauts, will observe the North and South Poles and conduct research on the impact of spaceflight on human health over 3 to 5 days. That's your Bloomberg Brief. John?
Very cool. Yahara, thank you. Thanks for this morning. Equity futures right now in the S&P then just a little bit softer. Lots of data later this morning. Lots of data later on this week. So up next on the programme, we'll set you up for the week ahead and the day ahead from New York. You're watching Bloomberg TV. Equities at the moment negative by 0.5%. We're down 0.4 on the Nasdaq 100 after snapping a 3-day slide in yesterday's session. Couldn't avoid a big monthly loss on the S&P. The worst month for the S&P going back to 2022. The S&P 500 down close to 6%. Nasdaq 100 brutal, down something like 8. On the Russell, we're negative this morning by 0.4. In the bond market, the buying returns. Yields are lower by 4 basis points on 10s to 4.16. We're down 5 basis points on 30s to 4.52. And the next stop for this conversation just an hour or so away. It's the economic data. Your trading diary looks like this. 9:45 manufacturing PMIs, 10 a.m. ISM and JOLTS data at 3:30 later on this afternoon. The president signing more executive orders on Wednesday. President Trump's tariff announcement from the White House on Thursday. Auto tariffs taking effect and another round of jobless claims. Then on Friday, we get the March payrolls report and you will hear from the Fed chair, Jay Powell. What a week we've got coming up for you. Let's head down to the nation's capital and catch up with Laura Davison down in Washington, D.C. Laura, we've had some reporting already this morning about what we may or may not see in the next 24 hours. Help us put it all together.
Yeah, so today the White House is still deliberating exactly what this tariff plan will look like. We may get some more details in the noon hour when White House Press Secretary Caroline Leavitt will come out and take questions from reporters. Trump is also signing some executive orders this afternoon around 3:30. He could invite reporters in there, and that will probably be the last chance we see him before tomorrow's tariff announcement at 3 o'clock in the afternoon in the Rose Garden. No doubt the White House staff will be working overnight to get this all finalized. Also in the background, down the street at the Capitol, the Senate is looking to advance that tax cut package. Senators meet with Scott Bessent today and looking to have some votes later this week on that.
Laura, also happening in the Senate, they're expected to vote on this Democratic resolution that basically would block Trump using IEEPA for Canada. It'll go nowhere in the House, but it could take a gut check on where Trump is right now in terms of support from Republican senators that are a little bit uncomfortable what's going on in terms of the trade between the United States and Canada. What can you tell us about this resolution?
Yeah, this will really be a litmus test to see, particularly on the Republican side, who is feeling anxious about some of these tariffs. You've had several senators come out and sort of brush aside, basically acknowledge, including the top senator, John Thune, saying he's not quite sure about the tariff policy, but hopes that whatever they can do in the Senate on tax policy will counteract that. Obviously, market's not happy with what they've seen over the past couple of weeks, and it's unclear, exactly how quickly and how big this tax package will be. That'll be the big question for markets and for the senators going forward.
This morning in Axios, they're citing a White House official describing the approach to taxes, saying this, quote, gun to the head, the whole agenda and the country's credit rating and global depression all rolled into one, a.k.a. raising the debt ceiling into reconciliation. Laura, is it your sense that that is why they're pushing so hard to make sure that the debt ceiling is in reconciliation? Because they need these tax cuts ASAP to offset what's going on with tariffs?
Yes, and this is really an implicit acknowledgement that Republicans have these very narrow majorities and that they basically have one shot to get everything they want to get done in one fell swoop. So this puts pressure on Republicans to get this moving forward. If not, a lot of people had worried that this may last till the end of the year, could really start to spook markets, investors, companies, and unsure if these tax cuts are coming. So having that debt ceiling baked in there, which looks like, the default date will be sometime later this summer. It's possible that that gets shifted upwards if tax collections are slow. So it's a little bit of a live ball right now on exactly when they have to pass this, but it keeps the pressure on lawmakers, and that's what Congress needs to get anything done.
Laura, appreciate the update down in Washington. It's going to be a busy 24, 48 hours ahead for us all. Laura Davison of Bloomberg. Down in the nation's capital tomorrow, 3 p.m. You surprised it's 3 p.m.? Market's still open?
Well, he can be late, talk a little bit until 4 p.m. But yes, because right now you're going to have immediate knee-jerk reaction at a time where this market doesn't seem to be fully factoring in 20% tariffs, which is, according to the Washington Post, potentially on the table.
That's one of the proposals. That would be one of the most maximalist approaches, why everyone thinks he comes in with 20% on all these trading partners, then it opens the door for negotiation. Potentially it's at 3 p.m. because guess what? This might leak. Today there is a report that Jamieson Greer, the USTR representative, will give the president on the trade imbalances, and potentially that will dictate what he decides tomorrow.
We'll look out for those leaks overnight. 20% could change. That time could change. For some people, the damage is already done to sentiment, and we've seen that in the survey data. Will that show up in the hard data this week? That's the other big question coming into this week. It's not just about the tariff announcement. What will we see in the economic data, which concludes with payrolls on Friday?
And then Jerome Powell coming out and maybe not offering a sense of how much you support. On the flip side, some sort of reaction function from the Federal Reserve. Not only do you have the hard data, you also have the potential reactions from Republican congressmen, which I think will be very interesting. And it was something that you asked about, but you're starting to see that on the margin, some pushback. Senator Ron Johnson, it's a high-risk move. I don't know what his strategy is, as well as John Thune of South Dakota, saying he's very concerned about this. There is a feeling that if that sentiment shift does continue for long enough, you start to get a real response.
There's another litmus test, and that's elections today, special elections. I'm looking at Mike Waltz's former district. The Republicans had some 30-point lead, and now it's in single digits in terms of how much that lead is. It's not so much the Republicans might lose. It's how much the Democrats might be able to win back and what the margins are of that race to show that maybe people are a little bit annoyed. CBS poll over the weekend. They want the president focused on bringing prices down, not on tariffs.
Where are we going to be in 9 months' time? Are we talking about no tax on tips, on Social Security, on overtime? Are we going to make purchasing an American car tax deductible again? The Treasury Secretary says yes. That's the bigger challenge in the months ahead.
If you don't have especially that consensus in Congress, but this is what a lot of people are betting on. And the reason why, with all of this negativity that we hear, people are still talking about a price target that's above where we are now on the S&P 500. Why? Exactly because of that. The first half tariff talk, second half, he'll own the data, that according to Howard Lutnick, and it's going to be some of the sweeteners, and that's what a lot of people were expecting coming into this year. Whether that actually comes to pass, of course, we'll be watching.
April 2nd is just around the corner. Equity futures at the moment, negative 1/3%. The opening bell, 34 minutes away. Tomorrow, your lineup on April 2nd looks like this. Mohammed Al-Arian of Queen's College, Cambridge. Andrew Hollenhorst of Citi. The former Trump trade official, Kellyanne Shaw. And former Obama economic advisor, Jason Furman. Looking forward to covering the story with you from New York City. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.